Unilever. Goldman, Tom, you talked about that upgrade to the price target over at Citi to 480 on Goldman, right now 407, just a little bit softer. But let's sit on Unilever together. That's rallying by more than 2%. Price is up 4.1%. Biggest price hike for the third quarter going all the way back to 2012. And the tolerance is there, Tom. That's the important piece of this.
Yeah, for Americans watching on radio and TV, listening on radio as well, John, I would really suggest Unilever and Nestle's as massive multi-product bans have for the last decade been instructive on how to get rid of failing products. Unilever, just as one example, owns Ben & Jerry's ice cream here in America. Who would have thought that? But of the zillion products they have, they're always managing for profitability, and they've really set the playbook of how you do that in consumer goods.
I'm willing to pay more for ice cream, Tom. I'm willing to pay more for ice cream.
Yeah, I can
I'll
see
cut back
you
elsewhere.
In Birkenstocks, Holistic, up in Vermont, New Hampshire.
I killed the Netflix subscription. I'll cut back elsewhere, Tom. I'll pay more for ice cream. Steve Chevron's with us now, portfolio manager at Federated Hermes. I won't speak for Steve. Steve can speak for himself. I bet. I do too, Steve. Let's build on this. Margins at the epicenter of the earnings story. The difference between the companies that can execute and the companies that are struggling to, Steve. What's your take on that right now?
No, I think this is the story. It's hard to imagine the multiple going a lot higher next year. You've got growth slowing some. Inflation, I think, is very much not transitory, and I think it's going to be persistent. So your upside in the market is your earnings growth, and right now, so far through the earnings season, it's been pretty good. And I think what we're looking for is how do the margins hold up? Are companies able to pass on price? And at a stock level, you really need to focus on companies that have pricing power. If they have pricing power, they can pass along those costs, then you know what? Inflation's fine for them. If you can't and it starts eating away at your margin, I think you need to expect to get punished. And I think that's what we're looking at, and we're sifting out the winners and the losers right now.
Steve Auth has a 20% return for the last 3 years in one of his portfolios, solidly upper quartile. And this speaks to Federated and Auth and the rest of you guys saying, you've got to be in the market. Speak now to our audiences who are saying, I'm scared stiff, I can't participate.
Yeah, well, first, it's been an honor to grow under Steve. I think he's terrific. But to that point, you've got to look in the market and say, where's the opportunity? So if we are in an inflationary environment, if that is going to be a bigger impact in the market, which we think it will, the question isn't, do I cut bait and run? The question is, which parts of the market, which trades do I put in place, that allow my portfolio to benefit from that trend, or at least get hurt the least? And so, building up from fixed income, that shorter duration fixed income, something in the 0 to 3 range, not as longer term. It means a little bit more high yield and EM debt, where you've got shorter duration and more spread tightening capabilities. It means equity income, dividend stocks to supplement your fixed income because you're getting a higher yield and it's a little bit more inflation durable. And it means value cyclicals right now, where these companies can pass those prices along. And then I think the last one is there's select opportunities in international, in our view, particularly in the international small and mid-sized space. So you can't just look to run away, because if you're not in the market, you won't achieve your goals. You won't get that compounding. But you got to look for the areas that are most advantaged, and that's what we're doing across our portfolios.
Steve, at what point do higher inflationary reads that we get on a repeated basis, this idea that perhaps it's not transitory, start to lead to higher yields that really put a crimp in equity returns?
Yeah, no, it's a great question. I mean, I think it depends on what kind of equities you're talking about. I think you're going to see some of the growth names underperform sooner, because remember, when you buy a growth company, you're buying it for their earnings out 5 or 10 years from now, and that can get inflated away. If I'm buying a value cyclical, I'm buying that because I think an oil price is going to be more tomorrow. Well, that's not going to get inflated away. And I think that's the nuance there, Lisa. Yeah. But we do have to watch. Yields that get too high do hurt multiples, and that could happen next year.
What you just heard there, folks, from Chevron is textbook, where growth is a longer-term x-axis and value is a shorter-term view. John, did I hear earlier on bonds that Chevron recommended the triple leveraged all-cash fund?
I'm not sure that's where it was going.
Was that what he was
Steve,
saying?
do you want to finish there? Was that what you were saying?
That's fake news. I'm calling you out there, Tom. Fake news.
Steve, thank you, buddy. Always good to catch up. Thank you very much. Steve Chevron there at Federated Hermes. Tom, that's the difficult part of this. Look, I know a lot of people come on this program and say it's the time for active management. It's the time for active management. And let's be clear, Passive's done very well. If you hug the index, you're doing great, Tom. This year, you're up about 20%. But when you go through earnings season, as Lisa pointed out, if you miss, you get punished. And if you're winning right now, it just validates where you've been. This is about choice, picking, and execution.
It's about time frame as well, John, and we're all guilty of this. I'm as guilty as anyone. Is our basic time frame is 6 months is long term, and that's just baloney. I mean, it's just, you've got to look at growthiness, whatever your belief is, where 3 years is short term. Who's got the courage to do that in the turmoil we're in right now?
Lisa, Mike Wilson of Morgan Stanley pointed out something to me last week, something along the lines of saying it's easier to forecast, say, 5 to 7 years than it is, say, next year. And look, next year specifically is really difficult to call.
I would agree. And I think that one of the key aspects of this is the idea that inflation could potentially dampen demand, right? Especially as you get this fiscal cliff. And at what point do we revert back to some sort of mean? In the meantime, everyone who comes on the show talks about looking at companies that have pricing power. So what does that mean that we have priced for those companies, John?
We're passing it on to the consumer. And so far, they're eating it up if it's ice cream. I think everyone's on board with that. I'll pay a little bit more for the ice cream.
What
That's
flavor?
just my view. Well, I like pistachio. I like strawberries and cream.
I'm gonna tear up.
You can get a nice olive oil ice cream. Yes, I know. Bear with me on that. Nice olive oil ice cream over in Brooklyn, Tom.
What?
Yeah, I'll take you down there.
I've had that before.
Olive
it's actually
oil
quite good.
Yes.
ice cream?
South of the border, Tom. I'll take you down there, okay? Futures down 12. We're negative a third of 1%.
I gotta go below 59th
Have you ever
Street?
been to Brooklyn?
No.
No, I have, Tom. I'll
Olive
give you a
oil
tour.
ice cream?
You've got to go to Brooklyn, Tom.
John, I'm tearing up. My mother's favorite was pistachio.
with some olive oil cake, Tom.
Oh, God.
Make it happen. From New York City. This is Bloomberg.
Disgusting.
With the First Word News, I'm Leanne Gerrans. The UK and New Zealand have agreed to a trade deal which includes improved business travel arrangements and reduced tariffs on clothing, buses, ships and bulldozers. It's a political boost for UK Prime Minister Boris Johnson. The government research last year estimated such a deal would have no long-term impact on the British economy. Now, former President Donald Trump has announced a deal that would enable him to regain a social media presence after he was kicked off both Twitter and Facebook. A press release says Trump plans to start a social media company called Truth Social. If it all goes according to plan, the venture would be up and running ahead of 2022 midterm elections. China's Evergrande Group scrapped talks to offload a stake in its property management arm and said real estate sales plunged about 97% during peak home buying season. That worsened its liquidity crisis on the eve of a dollar bond deadline. In statements to the Hong Kong Exchange late yesterday, Evergrande added it had made no further progress on asset sales and may not be able to meet financial obligations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter and I will always be a fighter inside and outside the ring.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It is a supply-side shock that the Fed can't do much about. They can't help the chip shortage. They can't help congested ports, certainly on the West Coast. But I think we should know that there is a demand-side story here. I think importantly from the Fed side, what they can do is maintain credibility for defending their 2% target.
Deutsche Bank is looking for a hike next year. That was Matthew Lazzetti, the chief U.S. economist at Deutsche Bank. From New York City this morning, good morning. Tom Keene, Lisa Abramovich and Jonathan Ferro. Your equity market down 11 on the S&P. 6-day winning streak, just a bit softer this Thursday. In the bond market, yields unchanged, 165.51 euro dollar, a little bit weaker on the euro side of things, 116.41, a whole lot weaker on the Turkish lira side of things. That central bank cutting 200 basis points this morning. We were looking for about 100 basis points. Tom, this in from Klaus Vistesen of Pantheon Macroeconomics. Olive oil ice cream, maybe in Brooklyn, but not convinced otherwise. Why does that only work in Brooklyn, Tom?
Well,
what's that about?
That could devote.
What's that about?
We'd have to have a separate show for that, John.
Another time?
Another time.
You want to move on?
Craft, Oliver.
Craft. Is they do craft down there?
John, we like to talk
down there.
We like to talk about positive things very quickly here, John. I think this is important. AT&T reports they make 55 cents on the dollar on wireless EBITDA margin. Great, that's all wonderful. The stock is 43 to 25 in 5 years. And it will be an MBA case study here.
You mentioned IBM, Tom, earlier. Periodically, you and I get the chance to beat up on IBM. Can you believe they missed out on pretty much the whole bull market in the last 10 years? That stock's down about 30% from 2012, 2013. How on earth is it?
John?
And we often go on this rant. This is a repeat of it, I understand. But I'm always scratching my head. How can it be that we're talking about a cloud business at an online retailer and we're not talking about the dominance of IBM in cloud?
I've talked to a guy that was a mayor once of New York City about this. And John, I'm humbled by this forever because I am what is called a Kodak brat. And I saw what you see in IBM now and others. I witnessed it personally long ago, opened me first in Rochester, New York. Humility is in order, John, and you really wonder where that's been at some of these companies.
And Tom, I'll be humble. I'm in the cheap seats. This is really, really tough. I just always scratch my head.
Yeah.
I know they're trying to get it done now with the Red Hat acquisition of the last few years.
Yes. Well,
pretty late, isn't it?
Yeah, with IBM, it's sporting to miss it, but with AT&T, you just really wonder some of the decisions along the way. Our good decision right now is to have Anne-Marie Horton join us, Bloomberg Washington correspondent. Anne-Marie, I mean, it's just as simple, given the last 24 hours news flow, including what Don Schneider did at Cornerstone Media, of a 4.7, I believe it is, statistic, I can't remember. What is the president's agenda today involving these two pieces of legislation?
Well, we don't know exactly who he's going to be talking to, but likely he'll be working the phones to try to get this over the finish line. And then this evening, he's going to have a CNN town hall. And this is his way to try to sell his agenda yet again on the heels of yesterday being his hometown of Scranton, Pennsylvania, to the American public. But something has changed. Yesterday, we thought we were a step forward, even if Jonathan had called it a baby step forward. Today, I have to say, I feel like we're taking a big step back. Yesterday, it was about what we can skim and sacrifice to get this bill over the line. And today, it's about ground zero yet again about how they're going to pay for it.
Well, John, you mentioned this, and this goes to John Micklethwait. John Micklethwait speaking with the Prime Minister the other day. You got to get in front of the camera. John Farrell, from where you sit, is it a town meeting appropriate, or does he have to start giving more interviews?
Look, let's talk about the interviews. Politico came out with the piece in the last 24 hours, and no one wants my opinion. This is the data. The numbers speak for themselves. At this point in their presidencies, Obama had conducted 131 interviews. President Trump had participated in 57. This president, Anne-Marie, has participated in 10.
10.
And Speaker Pelosi came out in the last couple of weeks and said that reporters need to do a better job of selling this bill. Do we need to hear more from the president?
It's not reporters' job to sell this bill, first and foremost. That's their job. When it comes to the president, the White House would say that he does answer reporter questions when he goes to those speeches. I've been to a handful. I've been to 2 where he's taken reporter questions ad hoc, not off of a list of today we have to give 3 or 4 questions to these different news presses. There is a lot of criticism about the administration not sitting down with media companies, with televisions. I believe he has not done a single in-depth print interview. So all those that he has done is in the form of television. That's the medium of choice. And of course, we would always welcome the President of the United States on Bloomberg Television.
Thank you so much,
Anne-Marie,
for that outreach and the open invitation to the president. I'm sure he's watching and will respond shortly. There is an issue, though. Part of the problem for him is who is his party? There is this identity crisis at the heart of the party, especially as we head into these Virginia elections, this idea of these purple states increasingly as more city dwellers move to less blue places. What does that do to the nature of the Democratic Party? Is this still considered the same wing of politics?
Just like the Republicans, he is dealing with very wide gap of the wings of the party, a very progressive left, a way more centrist right of the party, especially when you look at what happened yesterday, a report that Senator Joe Manchin is talking to people about if what he deems necessary to get this bill over, coming down to that 1.7, closer to 1.5 trillion. He said with his line in the sand that he would actually consider switching to be a Republican. Now, we've heard this before, and that's probably not likely, and the Senator Manchin had very choice words for that, basically calling it nonsense in a little bit more of a rude manner. But the fact is that the president is trying to bridge that gap, and I like, Lisa, that you mentioned the Virginia elections, because Senator Mark Warner of Virginia says, can we at least get hard infrastructure out? Virginia politics is so close to what's going on in the Capitol. What happens here, that is their local press. And if the mood music coming from Washington is the Democrats can't get anything done, that could potentially hurt them on November 2nd.
Anne-Marie, thank you. MH down in D.C., our Washington correspondent. We'll catch up with you a little bit later. Some interesting downgrades out there. This on Vale from RBC. It's a double downgrade from RBC, Tom, adding that China's economic rebalancing away from property and fixed asset investment hits at the core of the company's profitability driver, iron ore. So that's a shift, a double downgrade, going from outperform to underperform with a click of the fingers.
Credit Suisse with a nuance here, John. They stay with an outperform on IBM, but on International Business Machine, they lower the price target, John, from 176 to 172.
IBM down.
Can we
5%
model
of the
out a
pre-market,
year on $4 at 176?
I'd like to model out the next year, Tom, with some degree of accuracy. Right now, how do you model next year?
How do you model January?
I can't get to November, Lisa, at the moment. That's a couple of weeks away.
Yeah, and especially when you talk about stories like Vale, this idea that all of the commodities have been in hot demand and then a policy decision by China shuts that off real quick, and that's pretty interesting to me.
It's a big change, and you might see more still to come. Right now, we have futures down 11 on the S&P 500, just a little bit softer. Initial jobless claims coming out in an hour and 5 minutes. Good to see them south of 300K. Whatever your view on things, what the Fed should do, shouldn't do, where the market should be, where it is, whatever. We all want to see claims a whole lot lower in any economy. To see them south of 300, Tom, good news.
Very elegant chart, trending in the right direction.
We'll build on that in the next hour. From New York City this morning, good morning. Heard on radio, seen on TV. This is Bloomberg.
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place, the gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The longest winning streak since July on the equity market, and we come back just a little bit on the S&P 500. We are down by about 1/4%, negative 12 points. Likewise on the Nasdaq, down about 1/4% on the Russell, down a third. Yesterday, 5 points short of all-time highs on the S&P 500, 45.45. We were in and around 45.40 just for a little bit. That's the equity market. At the index level, let's get to the stock level story. Switch up the board and get to 3 of them. We can talk about one word specifically that we've talked about all morning so far. Execution, 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 execution at Tesla. Even with the same supply side issues that all the automakers are grappling with right now, that stock is only down by a little more than 1%. Execution at Unilever. That stock is up by 2.3% after hiking prices 4.1%, the most since 2012, and doing okay, passing it on to the consumer, and the tolerance is there. They are able to execute. And Goldman, Tom, that was the theme last week, executing. The rest of the street did too, but they knocked it out of the park, and that is about execution. As you pointed out, Tom, Citi with the price target upgrade, they go to 480 right now, 408 in the pre-market.
Now, at the beginning of earnings season, it'll be interesting to see what David Wilson reports, and also Gina Martin Adams at Bloomberg Intelligence as well. This is arguably the conversation of the day on what so many of our themes are. To summarize it into the global economy, he's the chief global economist at Morgan Stanley. Seth Carpenter joins us this morning. Seth, one of the great themes of the global bulls is Asia to the rescue. Not so much China to the rescue, but a broader Pacific Rim. I'm not smart enough to know if I fit India in it as well. With all of your research, all of the work that Stephen Roach set up 20 years ago for your shop, can it be Asia to the growth rescue?
Well, I think there are 2 parts to that question. I think you highlighted the difference between China specifically versus Asia more generally. And there, we're not looking for China to be the engine that pulls the global economy forward. We're looking for about 5.5% growth next year. We think the slowdown that's happened right now, that happened in Q3, is very real, but sort of overstates where we're going. So some recovery there, but only sort of moderate growth next year. I think the way in which it could well be Asia to the rescue is the other key story that people are talking about, which is supply chain disruption. So much of what we're looking for, especially when you think about semiconductors coming from Asia, and our semiconductor analysts are being very attentive to looking for how that flow of semiconductors is going to go, and the rest of the global supply chain, I think, is key to the story for the recovery next year.
Well, let's get out front of your Monday note. I mean, I only want to get out 3 days ahead of it, Seth, so stay with me here. Your advantage is your analysts on semiconductors and else. What do they say about the duration of a supply shock slowdown?
Well, I think that is exactly the hardest part to answer here, and where the uncertainty is so large. But we are looking for gradual, over the next 3 and 6 months, a continued normalization in supply chain so that things get back online. It seems clear that the auto industry is in a bit of a tougher situation than sort of semi-supply overall. But we do think it's going to take some time. But, we're guardedly hopeful things are going to go in a normalizing direction.
In the meantime, Seth, you said that you believe the role of demand is underappreciated, that basically consumer spending has hung in there, and we've seen company after company show that they can pass along price increases to consumers. How long, though, can that continue with the idea that price inflation continues to exceed wage inflation?
I think, that's a key consideration. So demand has clearly been strong. If we look at the components of consumer spending on goods in particular still is much higher in a relative sense than it normally is. So we are looking for that over the next, again, 3 to 6 months to come back in and have a little bit easier demand there. But there has been surprising strength for consumers. Wage inflation, though, has not kept up with inflation. And so as a result, normally we would think that would be bad for consumer spending. We do, however, in the current circumstances, have a bit of a cushion of that excess savings from all of those fiscal transfers that we had earlier in this year and last year. Now, for the middle and lower end of the income distribution, those are getting depleted over time, so it can't sort of be the crutch forever. But we are looking for that shift in consumer spending away from goods back towards services. We're looking for supply chains to start to ease over time. And so as a result, the consumer should be able to hang in there and stay reasonably strong.
There's a psychological aspect to this, too, that I've seen highlighted by a number of Fed researchers, that people are more willing to spend money that they make actually from their paycheck than from their savings if they don't have a clear sign that their paycheck is going to rise at the same pace as inflation. How much do you factor that into your equation as we look at a world where that savings rate is not being depleted as quickly as people thought?
Absolutely. So when the government transfers kicked in and we saw reported income jump straight up, that savings rate jump up very dramatically, there were a range of estimates on the street as to how much of that excess savings was going to turn into consumption at some point. At one end of the range, there were folks who were saying that all of it, all that money that sort of accumulated in bank accounts and other places is just going to sooner or later flow into the economy and turn into demand for goods. We took a much more conservative view and assumed that only about 10% remaining is going to turn into consumption spending. You always see in the data, consumers spend less out of wealth than they do out of current income. Current income spending, estimates 60 to 70 cents on the dollar, whereas spending out of wealth is much, much smaller, 5 cents on the dollar or less.
Seth, how have you nuanced the mystery, the glide path of 2022? I mean, Ellen Zentner's been way out front on this, but just the vector down, there's got to be a time function. How has it changed for Morgan Stanley?
Well, I mean, I think one of the key elements about 2022 and whether it's going to be a smooth transition or not is the debate about the role of fiscal policy, which ties us back, in fact, to the previous conversation. I mean, we had a huge drop in income. Most of the fiscal policy was then shoring up that income. Yeah. We saw the saving rate go up. And so from my perspective, then, anyone who's looking for this massive fiscal cliff, if you're just looking at the change in the deficit from one year to the next, I think that's the wrong analysis in current circumstances. There is income replacement that kept the consumer on track. There is excess saving that could buffer to some degree any fall in income. But the fall off in fiscal stimulus right now is not going to lead to a cliff because it didn't lead to anywhere near as much of a boost in 2021 as we had thought. That's why we saw that saving rate go up, is because consumers were smoothing through it. So if they smooth through it this year, it's going to smooth through it to next year when that impetus goes away.
To take it globally, do you model in a fiscal drag either with the mystery of the present legislation in America? Do you model in a fiscal drag for Germany, continental Europe, and particularly for the UK?
Right. So, I mean, I think when we're looking at Europe in particular, there's still an open question about what's going to happen with the coalition there, how much easing there's going to be. And then for the rest of the continental Europe, there's the recovery fund, how much stimulus there's going to be coming out of that. Super difficult to know. Modeling those multipliers is hard, but we're actually fairly constructive about what's going on next year in Europe. The UK is a challenging area because, of course, they've got higher inflation. They've got labor shortages like, the United States does to some extent coming out of COVID, but those are exacerbated by the Brexit-induced labor shortages. And so you're seeing everything playing out in a much more acute way. We heard Governor Bailey over the weekend coming in fairly strong, fairly hawkishly about the need for monetary policy to react to inflation and inflation expectations. So I would actually put the UK in a different bucket in that regard, where there's going to be much stronger headwinds there. But labor demand is held up. That's one of the reasons why they're worried about inflation expectations. And so it doesn't have to be a disaster story. It's just in a bit of a tougher row to hoe.
Related to the idea of labor demand holding in there, and that's actually, to put it modestly, we're about to get in 50 minutes time the latest U.S. initial jobless filings. Why is it still so high, albeit the lowest since the beginning of the pandemic? Why are we still seeing something around 300,000 people every week filing for unemployment benefits when we have a record number of job openings?
Yeah, record number of job openings to be sure, but we had an awful shock. When I think about typical cyclical behavior for the labor market, the economy goes down and then it just takes a long time for the labor market to fully heal. And I think people are trying to figure out what's the right role for me in the economy over time. But we do see the employment to population ratio rising fairly steadily since the worst of the COVID shock. We see labor force participation continuing to rise. I think much more important than this week's unemployment insurance claim number is going to be the upcoming jobs report and subsequent ones, where we get to understand after schools have been back in session, how many months does it take for parents to come back into the labor market? As COVID mortalities and hospitalizations continue to fall, how many people come back into the labor market as that fear of COVID starts to wane? The FDA is talking about approving COVID vaccinations for kids 5 to 12 years old. Once those children are vaccinated, how many more parents then are willing to come back into the labor market? I think that path for labor supply in the United States over the next 3 months, 6 months, 9 months, that's really going to be key to understanding the evolution of the U.S. economy.
Hey, Seth, wonderful to catch up. As always, sir, the chief economist over at Morgan Stanley, Seth Carpenter there. One of our lead stories right now here at Bloomberg, the Central Bank of Erdogan cuts rates again at the lira's expense. Here's dollar lira right now. Dollar try all-time highs. That's all-time weakness for the Turkish lira, Tom. Dollar lira, 942.
Okay, I'm going to say this, John, right now. I just did the weekly chart for global Wall Street. This is real straightforward. On a standard deviation basis, on a weekly chart, dollar lira is weak lira out to 3 standard deviations, that at the 946 level as well. We just touched that for a cup of coffee, a good Turkish cup of coffee. John, the trend here is incredibly elegant. The chart is literally teacher course. Weak lira.
I know what you mean by the word elegant, though for Tom, for many people, it's brutal. It's brutal right now.
Mathematically, this is an incredibly persistent trend, John, with an inertial force. The number one thing I would say, John, is in all the time in Istanbul, it's 2 fixed income markets. How does dollar denominated adapt? How does lira denominated adapt?
What do you think they called the recent increase in inflation, Tom, over in Turkey?
Transitory.
They called it transitory. I'll bring you some of the commentary from that central bank a little bit later. They cut rates 200 basis points. Inflation is running at close to 20% in Turkey. A very different conversation. From New York City on radio, on TV, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. South Korea has successfully launched a home-developed rocket. The 200-ton liquid fuel rocket lifted off from the country's southern coast, then released a dummy satellite into orbit. South Korea sees its rocket program as bolstering its competitiveness in next-generation 6G communications, while attracting attention as neighboring North Korea does add to its missile arsenal. India has given out 1 billion doses of COVID-19 vaccines, but while 51% of the entire population has received at least 1 shot, only 21% are fully vaccinated with 2 doses, according to Bloomberg's vaccine tracker. That could mean more outbreaks in the country that earlier this year experienced one of the world's most devastating virus waves. Here in England, the government has been accused of being willfully negligent by not implementing its Plan B to tackle rising coronavirus cases. The British Medical Association says measures are needed to avoid further pressure on the health service this winter. Health Secretary Sajid Javid said the government wants to avoid bringing back tougher measures and warned that new daily cases could rise above 100,000. He urged people to go and get vaccinated. Volvo says chip shortages and supply chain disruptions will continue to cap its truck making, forcing the Swedish manufacturer to turn away some customers. The company said the disruptions and stoppages in the production will continue, but the company reported a third quarter adjusted operating profit of 1.1 billion. Now that's beating the average analyst estimate. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Earning reports are going to be a really important bellwether indication of how companies are navigating this, because let's not forget, one of the things that's been one of the narratives this year is that companies have actually been navigating these challenges surprisingly well and in a profitable way, and all the incentives are aligned for them to do so.
I thought that Julia Coronado yesterday was absolutely fantastic, Tom. The founder and president of Macro Policy Perspectives, with Tom Keane and Lisa Brambert. I'm Jonathan Ferro. Your equity market down 12 on the S&P. No drama here. What are we down by? A third of 1%, Lisa. We're not doing much. Yields up a basis point, 166. What are we, 10, 11 basis points short of the highs of the year, Lisa, here?
Yeah, I mean, look, we are looking at a really robust market, but earnings are really good, to Julia Coronado's point. And the point, really, the question is, what's priced in?
We've mentioned the number a few times this morning, Tom. 84% beats so far on the S&P. Early days, but so far so good.
Early days. We'll talk to the expert here in a moment. Not on that topic. What we're going to do here is special. We're going to talk hydrocarbons and then go over to electricity as well. That seems to be the modern thing to do.
Dave, back and look at that. I mean, the latest reading, roughly 5.5 times. That's what you're talking for a ratio. You go back, look all the way to 2010, the average more than 12. So, you know, we're way down from where we've been. And Bernstein pointed out, this was all on Twitter the other day, that, you know, you're seeing readings that are similar to what you saw in the 2000s, when, by the way, energy was the best performer among the 11 main industry groups in the S&P 500.
One final question, and you're reading right now, is everybody bringing it up? Is 100 the new 90?
Well, you know, it's sure looking that way, and you've got much more of a focus on oil at this point. I mean, this was an unloved asset for a long time, and now that it's rallying, it's definitely attracting more attention.
Because of time, we've got to go here. Kevin Tynan joins us with Bloomberg Intelligence here on electric, moving from hydrocarbon over. I want to dovetail this in, Kevin Tynan. Yeah, Tesla with a really nice effort, but all the buzz is on General Motors. Dan Ives yesterday with Wedbush making clear this is a technology company. Kevin, you are hugely qualified on this. Do you buy the EV excellence of General Motors?
I do, yes. And I also buy it in companies like Volkswagen and Toyota, even though Toyota has talked about hydrogen a lot and been slow to move in electrification. I think all those global scale companies have the ability to do it. Just the profit dynamics haven't followed to this point, and they've just been slow to get involved in that way.
I'm glad you bring it up. Lisa Abramowitz has the order in for the 2022 Hummer H3 EV, the Edition 1, priced in at $113,000 large, Kevin. Could they make an electric car for mere mortals instead of Lisa?
Eventually, yes. I mean, and Tesla was a good indication of this yesterday. If you look at their average selling price, that was in the mid to upper 40s, right? So when you think about the way they started with six-figure vehicles, and they've sort of moved all the way down to below 50,000, and granted, you know, a lot of that volume is going to be China, which transaction prices are just lower than what they are in the U.S., and same for Europe. But to be able to expand margins as transaction prices get lower and lower, same thing will happen as global legacy automakers start to scale production of electric vehicles.
To be clear, that Hummer, that electric vehicle that is a Hummer, has to charge for 3 weeks to get you, Tom, from the Upper East Side to Brooklyn for one night. There is a question, though, in all seriousness, about profitability, Kevin, when you talk about that. Tesla showing that actually they can make it more profitably with their margins actually going up pretty significantly. How much is this a sea change for the likes of General Motors that's very much investing in this game?
Yeah, it is. But the other thing, too, Lisa, you have to think about is that it's happening on internal combustion now also. I mean, some of the transaction and pricing data that we're seeing or we saw in the third quarter is unbelievable. And I'll give you an example. In the U.S., typically we average about 6.5% discount from MSRP. So meaning you could walk into any dealership and expect on a $42,000, $43,000 vehicle about $2,700 in haggle immediately, and the dealer won't blink. In September, that number was $70. That discount was 0.15%. So basically, the consumer is paying sticker for vehicles across the board here, and there's no more cars, and I mean coupes and sedans. General Motors' best-selling car is Corvette, which averages $82,000. So transaction prices are going up, discounting is going away, and incentives are going away. And I think the interesting thing coming out of this earnings period and the rest of the year is how much of that sticks going forward, and that the industry changes to this flood of supply to a much better supply-demand balance.
Kevin, how long can Tesla remain the leader here?
Well, until it's profitable for everybody else. I think, you know, the Volkswagens and Toyotas and General Motors of the world have scale advantage in that they're global in terms of design, engineering, production, distribution, finance, after sales, all those things. They're just not doing that technology specifically yet because it hasn't been profitable to the extent that their traditional drivetrain technology is profitable.
Got to leave it there, Kevin. As always, thank you, sir. Kevin Tynan there of Bloomberg on some of these auto manufacturers. Tom, GM up 39% year to date. That's a good year so far for that company.
I've missed this, John. You know, there's things you get, there's things you don't get. I missed Brazil, John, a million years ago, totally. I've missed this. I didn't listen to Kevin Tynan. I didn't listen to Dan Ives. You know, I'm sorry. This is a new GM, and, you know, the engineer, Mari Barra, gets a lot of credit for this.
That was the standout yesterday for me, to talk to someone like Dan Ives of Wedbush, to go through the companies that these guys cover. Tech firm, DocuSign. Lisa, we're talking about Apple with the likes of Dan Ives. And then all of a sudden, GM pops up in the last 6 months, and it's a big focus for these guys.
So which companies get pushed into that new regime? That's my issue. Has he also started to cover Ford? Why is Ford not in there, right? Because all of the vehicle companies.
That's coming next, Lisa.
Right, and Ford shares are up more than 80% year to date. I was just looking at that. So if you take a look at what's being priced in, it gets very curious in terms of who could potentially catch up to Tesla and their moonshot.
You can get the all-electric Porsche for $83,000, Tom, if that's what you fancy.
And they're selling more of them
than the 911.
Than the hydrocarbon one.
Yes.
Yeah.
I saw that.
There it is, John. I mean, you know, folks, you got to understand, none of us drive. I mean, we're just all Manhattan idiots.
Speak for yourself.
One of us does, Tom.
Excuse
one of us
me.
does. One of us does. Not.
Where are you going to charge your electric Hummer?
Isn't
Just
that an
saying.
infrastructure plan?
Well,
the
this
big
is-
one.
Well, is it?
I think some of that, yeah.
Yeah, it's all going to get solved in Glasgow.
You know what I love about this show? When we have conversations and no one knows what they're talking about.
It's crazy.
They're the best.
It's like a marriage.
The best. Down a third on the S&P. We're negative 13
Maybe it's like
points.
a divorce. Let me think about it. Is it like
Is
a
it, Tom?
marriage?
Is it?
Is surveillance more like a
boy.
marriage, or is surveillance more like a divorce?
You're a very experienced man. Which one is
Send us your emails. Send us your thoughts.
it? Good morning. Have a fantastic day. This is Bloomberg.
They're extremely thankful. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
what we see is an earnings season that's likely to be more volatile.
We have a market that is earnings driven.
We've been in a highly profitable, highly productive economy despite all of these frictions and challenges.
We are where we are because central banks have essentially taken it upon themselves to prevent any downside from ever occurring.
If it slows too much, you start getting zero-type numbers and people start worrying about the cycle again. That's a different story.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. In this hour, claims it's my most elegant chart. There is a persistency to lesser claims and a better America. John, that dovetails with what we see this early earnings season.
Earnings are good so far, Tom. So far, so good. We came into earnings season worried because we saw Nike, we saw Bed Bath & Beyond struggling to meet demand with supply-side issues. It was always going to be about who handles the cost pressure, what margins look like. There have been some success stories, and this morning, Tom, Unilever's one of them. Putting up prices in the third quarter by 4.1%, the most since 2012, and the consumer able to absorb that. Can you repeat the act? Then repeat the act, and if you need to, repeat the act a few more times.
The gloom crew pushed aside, and yet there it is. The shorts are out there. The people that are saying, look, it's top, top, top. I don't see a catharsis, John. Do you see taxi cab drivers telling you what to do with Tesla?
Not yet, Tom. Not yet. Although I have to say that several years ago when they told me what to do with Bitcoin, Tom, I should have listened. I should have listened because I looked down my nose at some of those suggestions and I missed out big time. Yields are up, Tom, by 2 basis points on 10s to 167. Yields are up on 2s as well. Yields are up in the equity market still within a whisper of all-time highs.
Oh, there he goes back. Lisa Abramowitz on radio and television now.
Not whisker, but whisper.
The basic idea here, the last 20...
Thank you for explaining that, John.
Lisa, the last 24 hours for the president have been a change. John Farrow trashing the president of the United States earlier.
Can I just clear up that I didn't? I was just copying him when he leans into the mic.
Okay, well, I'm leaning into the mic. Lisa, can you explain Washington?
No, I can't explain Washington. What I can say, though, right now is that they're struggling to understand how to read some of the inflationary pressures. I do want to just highlight the fact that 5-year break-even rates in the United States just rose to the highest since 2005, and this comes as we see consumer prices continuing to rise. And I just take a look at this, and there's one thing for there to continue to be growth. The question is, at what point does it decelerate enough that it creates an issue for markets that really are shrugging it off and looking at earnings that look great, Tom?
Well, they look great, and we'll have to see. And I got a lot more information coming on that in the coming week. John, let's get to the data so we can beat Sam Stovall up to death on the future of the market. He's 120% invested. What I'm noticing, John, is the VIX, even on pullbacks, 16.10 is a constructive number.
And here we are, Tom. We're down just 14 points. It's not a big move, is it? We're down a third of 1% into Thursday. 6 days of gains. Yields higher on a 10-year nominal yield, up by a basis point to 167.27. But if you subtract the real yield of the inflation-linked maturity curve from the yield of the closest nominal maturity, you get the so-called break-even. Take the 5-year maturity, and to Lisa's point, Tom, we're starting to climb again. And Lisa, I think you're right to bring this up because, Tom, this peaked back in May, then it settled down, and now it's a story again. It's a story again, and is it a story for this Fed? That's what we need to try and understand a little bit more.
Yeah, and here, hold my hand over here, please. Would you hold my hand? I'm going to talk to Lisa about auctions now. Lisa, the 20-year auction.
Virtual, carry on.
It's virtual. Lisa, the 20-year auction didn't go well, did it?
No.
What does that signal?
It signals that on the margins, people are getting a little bit more concerned about long-term interest rates. Although I will just say this, honestly, it's hard to draw any long-term narrative from an auction right now that's fast-moving in a market that's increasingly unpredictable. So I don't want to make any broad assumptions. I will say, though, the idea here that we're looking at inflation expectations that are climbing, at least in the medium term, and a market that still is not reflecting that in absolute rates is very interesting and a tension that will persist.
Sam Stovall with us right now, Chief Investment Strategist of Keeping You in the Market with CFRA, and of course, decades of experience founded on You Better Know Your History. Sam, the gloom crew's out there citing history. You say, yes, it's a guide, but far more history as gospel is a threat to your pocketbook. Explain how you use history into the end of this year.
Well, good morning, Tom. Basically, what I look at is knowing that the S&P 500 is likely to close above the September 2nd all-time high fairly soon. The question is, going back to World War II, looking at the prior 60 pullbacks or declines of 5 to 10%, how much further did it go beyond that recovery level before stumbling into another decline of 5% or more? And the answer was the market has risen an average of 8.4%, a median of 5.4%, and it's taken about 98 days before we, on average, slip into a new decline. So when you look also to how well the market has done from the low point of October to the end of December, average gain is a slight more than 7% and a frequency of advance of 92%. So basically, there really is a Santa Claus.
Sam, what is it about seasonals? When all of us first got into this business and heard all of this, it sounded like hocus pocus. What is behind it all, Sam?
Well, Jonathan, I think a lot of it has to do with capital inflows. You know, the old sell in May strategy is basically implying that most of the money is put to work early in the year, and then you simply have rotation in the summertime months when investors are focusing more on their TANs and their portfolios. Toward the end of the year, however, because you have a lot of window dressing by mutual funds with their fiscal year closes in October, you get that stuff out of the way, and then investors are looking 5 quarters ahead. They're looking to the end of the next calendar year, and what doesn't look good when you look that far down the road. So I think the seasonals tend to benefit, again, because they're gearing up for the new year.
What doesn't look good when you look that down the road? Thank you, Tom. I appreciate that. There is an issue, though, here. Are people looking too far in advance and pricing in what they're expecting in, say, 5, 10 quarters and not what they might see in a couple quarters, which is why you're not seeing big rewards for companies that beat their expectations?
Well, I think the real worry, as you had mentioned earlier on, is the question about profit margins. Still, the forecast is for an improvement in profit margins slightly in 2022 over 2021, but depending on how high oil prices go. Right now, our estimate is that we're really not going to be hitting the $100 mark anytime soon, though we do see a higher creep over the next several months. Also, in terms of the 10-year yield, our belief is that it is going to creep higher, but remain below 175 in much of 2022. So it really depends on what kind of headwinds and how strong they end up being.
Sam, around the iconic 5-star system of S&P and CFRA, and I think of all the work that Value Line did over the years, how do you star analyze these ginormous tech companies?
Well, basically, it's fundamental analysis. It's GARP, growth at a reasonable price. And what our analysts do is look to a discounted cash flow model.
How far out do you go? How do you take them out further because they're so unusual?
Well, I think that, you know, first off, the STAR system is for the coming 12-month period, but obviously you look to PEG ratios, you look to long-term growth versus valuations, et cetera. But really, investors are focusing more on the coming 6 to 12-month period. So that's what our stars do. But we also look at relative valuations. We look at sum of the parts. So all of the different kinds of analyses that fundamental investors do. And also, since CFRA recently purchased Lowry Research, a technical analysis firm, we know that fundamentals tell you what, but technicals tell you when and how far.
Wow.
Interesting stuff. I like that line. I like
nice
that.
Plug there.
That's
you
beautiful.
That in, Sam.
Sam, thank you. Thank you, sir. As always, Sam Stovall there of CFRA.
Technical analyst.
Speaking of ratings, the team at Bloomberg put this one together. I find it fascinating. Tesla, if you go to the market cap of Tesla right now, $870 billion coming into today, just short of that. Then you go to the credit, Tom. Now, the line between investment grade and high yield is triple B down to double B, right? That's the line in between those two. The credit, 2024, I'll pick a credit of Tesla right now, double B. You've got a junk-rated credit in the credit market with a market cap of almost $1 trillion. Don't you find that odd, Tom? Where have we ever talked about that before?
John. And what I find amazing here in the huge ascent of Tesla, major shout out to Matthew Winkler, our founder and editor-in-chief of Bloomberg News. And John, all I know is the disciples are on board and the critics are still there.
Just unbelievable. Lisa, to see a double B credit with a market cap in the equity market of close to $1 trillion.
Well, let's also remember where they came from. I mean, people were basically completely dismissing their plans of profitability, and there was this key existential question of whether this could ever be profitable. And now they've reported 9 straight quarters, I believe, I will go check, of profitability. All of a sudden, this is a new company that's actually looking at a lot of hopes and dreams that other companies are trying to emulate. At what point do they get upgraded? Are the ratings companies just behind the curve?
I remember the issue that they came out with several Augusts ago. It was several years ago, Tom. And it had a coupon of 5.3%. Yeah. And at the time, for that maturity, for that credit rating, it was a record low yield. A lot of people in the credit market, myself included, very snarky about how that issue priced. Tom, here we are. Here we are. And Elon Musk, I keep going back to this, Tom, Elon Musk has proved so many people so wrong over the last several years.
Not only on this, but on other things as well. We talked, a week ago, John, about his effort in real space versus others flying up 160 miles, whatever the number is, I can't remember. But I've got to admit, his space effort is extraordinary. And from what I just wish they'd make a Tesla I can get in.
It's too small for you, Tom.
Is that asking too much?
How big do you want it?
I thought
they're making a truck for you.
Yeah, I wanted to go on, Lisa's got the Hummer. It's worldwide now. The Edition 1. Just make the EV3 that they're making.
Get that big truck for your
Tesla,
TK.
Fact check, I do not have a Hummer. Fact check, I don't even have a car.
Lisa, people familiar with the show know.
I'm just letting people know.
They know.
Just letting them know.
It's worth letting them know now and then, but I'm pretty sure
Weston called up Mari Barra. Weston called up Mari Barra and said, get her a Hummer.
Yeah.
Tom Keane, Lisa Bramitz, and Jonathan Ferro. If we did fact checks on this show, we'd be very, very busy. From New York City, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Congressional Democrats are at odds over both the tax and spending sides of a bill to enact the bulk of President Biden's economic agenda. The chances for agreement by the end of the week, which seemed in reach on Tuesday, are now receding. That's as leaders intensified a search for alternatives to tax hikes and climate provisions amid opposition from Senators Kristen Sinema of Arizona and Joe Manchin of West Virginia. Now, Pfizer and BioNTech say a booster shot of the COVID-19 vaccine restored full protection in a large study. The result is likely to bolster the argument for giving a third dose of the vaccine. The companies say a booster was 95.6% effective against symptomatic COVID-19 in the study, which followed 10,000 people aged 16 years and older. New virus cases in New South Wales, Australia's most populous state, jumped 89 from the day before to hit 372 infections today. The spike is the biggest daily increase since mid-September and comes 10 days after the state lifted a widespread lockdown that did last more than 100 days. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
From New York City.
We're in London, in Sydney, in
San Francisco.
9
a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It was April of last year that we ran out of storage and oil prices went negative. No place to put it. But this time we worried with a cold winter that days of forward demand coverage could, for the OECD as a whole and for observable inventory, get down to 50 days. That's almost unheard of. So it's the exact reverse of 14 months ago or 15 months ago.
What a turnaround. That was Ed Morse there, the global head of commodity research at Citi. From New York City, alongside Tom Keene, Lisa Abramovitz and Jonathan Ferro. Here's the market right now. Equities down 14, negative a third of 1%. Yields higher by 2 basis points, 167.27. 10 basis points short now of the highs of the year. Highs we have not seen since the end of the first quarter of this year. 82.94 on crude. And Tom, just to repeat what Ed Morse of Citi just said, the turnaround in this market is unbelievable. We've been talking about running out of storage 12, 14 months ago. And now, when it comes to things like copper, we're having a real conversation about there not being anything in storage in LME sheds, Tom, in LME warehouses.
We're trying to have a real conversation, John, not only about that, the supply, the demand, the dynamics of it, but the underlying economics. And Rita said on copper, well, we'll see how she does here. On copper is interesting. But, John, you know, we're making jokes about magnesium, and I would suggest the manufacture of aluminum, the manufacture of magnesium, the manufacture of copper still goes back fundamentally to hydrocarbons.
And, Tom, you pointed out what's been happening with zinc and the likes of Glencore. When power prices go up and it costs more to develop some of these metals, Tom, what happens? They pull back on the production and development of those metals. And what happens then? The price keeps going higher. And Tom, this is very, very, very circular and becomes a self-fulfilling cycle as well.
Yeah, and the value that we have, folks, is each of these analysts approaches this differently. Ed Morse just there, John, is much more geopolitical, geostrategic. What will the Saudis do? Jeff Curry with the microeconomics from Chicago is very precise and concise. I think Francisco Blanch over at Bank of America really identifies a more holistic view of all the commodities. And everyone's different, including Amrita.
So that's the commodity market. Amrita Sen's going to join us in just a moment, Tom. As we get that ready, Lisa, let's talk about this bond market. This is a change. We've gone from talking about break-evens almost exclusively, higher inflation expectations. That peaked in May, then it faded away. Now that's the story again. Your nominal yield is at 167 on 10s, just a couple of basis points higher. But it's the break-evens, that part of the conversation I want to pick up on. The market implied inflation expectations, just working through some of this bond market math. You subtract the real yield on the inflation-linked maturity curve from the closest nominal yield, and right now, the focus, Lisa, is on 5s.
Yeah, the idea here that the 5-year break-even rate has risen to the highest since 2005. This isn't just an oil story, right? This isn't just a commodity story. This is also a toilet paper story, a paper towel story, a going out to a restaurant story. And I do think about supply chain disruptions lasting well into next year and beyond. The idea that labor market shortages are going to take time to really work through. This is all going into market expectations. And to me, this is meaningful. Why are we not seeing the actual nominal rates rising at the same pace?
Well, they have been. They have been. They're having a big lift at the front end on 2s. We've been having a big lift at the long end as well on 10s. We're back to almost 177. I think where the conversation has changed for me, it's much more global now. We're seeing this take place in the UK.
Yeah.
And central banks are actually responding to it. The UK is talking about hiking interest rates. New Zealand has done. And I can take your pick in EM. There's tons outside of Turkey that have done the same thing. Now, the issue is, does the Federal Reserve join in? That's where we're at right now for November 3rd. When we all sit around these tables, these podiums, Tom, in a couple of weeks' time for the Fed meeting, we talk about taper.
Yeah.
The focus is going to be higher interest rates. The taper story is done with. This is going to be about the what next. And Deutsche Bank and Matt Mazzetti are at year-end next year.
I strongly agree on that. What we do agree on is Lisa Bramutz and I can't pronounce Glasgow. John Farrow can, so we're hugely advantaged to the end of the month. John, take the hydrocarbon story and fold it into what you perceive will be the end result of Glasgow in COP26. To be honest, I don't see much there.
I will tell you, Tom, the answer to that if I knew it. I've got no idea. You know how this works. They're very scripted events. Lisa, you go into them, the diplomats get around a table before they even begin, and you basically script the outcome of them. Yeah. Right now, as far as I understand, speaking to Anne-Marie on a daily basis about what's going on, it's been very, very hard to get anyone to agree on anything going into this. That conference, that climate change conference starts at the end of this month and runs for about a week. And there seems to be a scramble now to find something to deliver through that conference.
The idea here that it's not just disagreement among the constituents, but also disagreement among the nations themselves, including the United States heading into this. But this all dovetails into the oil story that we really started on, right? The idea of the transition and the fact of why this is not going anywhere. I do want to go back, though, to this question of a changed environment in yields. I think that that's a really important idea, and it really is a difference as we look out. You said, yeah, yields have been rising, John. But to me, have they been rising to the same place that they should be if the Fed were not involved, right?
God, where should they be? I mean, come on.
But this is the reason why.
I've got no idea.
But this is the reason why the bears have been bearish, right? Is because they've looked at the fundamentals and they said there should be higher. They should be this, or else this does price in some stagflation or something like that. And other people are coming out and saying, it'll stay this way for a long time because central bankers are going nowhere.
If you obsess over levels, you will go nuts. What's important is about the direction of travel. We've gone from lows of 112.58 at the start of August, and now we're looking at having a look at testing the highs of the year so far, Tom. And it's the character of that move that matters too. It was about real yields in the first move that we had off the bottom of the lows of August. Now it's about inflation expectations, as you pointed out, Lisa. This is developing into a bit of a test for the Fed here, particularly at the front end. How they respond to that in the next couple of weeks, Tom, I think is really important. I don't want to over-dramatize it because I don't think it's too dramatic right now, but there's clearly a market that's pricing in hikes and a Fed that's saying not to.
Yeah, that's absolutely true. But
bottom line.
The insight I learned yesterday from Dr. Coronado was the idea that you take Atlanta GDP now and you add on to it the complete messed up realities of Detroit, and maybe that gets you to a better number where it's not so urgent for the Fed to do, and they can wait. John, this is really important, and we thank Mr. Cohen for emailing in on this. This is critical. It's pronounced Glasgow, John. I'm learning each and every day.
Did you not know that, Tom?
I did not know that.
What have you been saying?
I just butcher it.
Like Moscow. Have you been saying the Moscow, Glasgow?
Yeah, exactly.
We say Moscow too.
John, I'm a tourist. I'm sorry.
Hey, Tom, we all are, aren't we?
Glasgow.
I'm not from Scotland.
I'm just, it's going to be a mess from what I hear. I mean, the logistics, the response from
the deliverables,
Scotland, the
fact that President Putin, Xi of China is not going to be there.
And, I noticed the Queen at 95 and, the uproar over traveling to Ireland. She was in a reception line, and there was a former Secretary of State clearly on his way to Glasgow. And you wonder what John Glasgow?
You've got it.
Got it. Nailed it. You wonder what Secretary Kerry accomplishes there, John. I'm very uncertain on that.
Tom Keane, Lisa Abramowitz, and Jonathan Ferro driving you through the price action and setting you up for the end of this month from a climate change conference, Scotland. At the end of this month, going in to a Federal Reserve decision at the start of next month on November 3rd. Yields are higher by about a basis point to 166.57. In the commodity market, 82.96 with negative 5/6% there. Equity futures are negative 12 points and down about 1/3%. After a 6-day winning streak on the S&P, longest winning streak going back to July, we pull back just a little bit, just short of all-time highs. Beautiful New York, this is Bloomberg.
Limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question. Wonderful. Who of you has a driver's license?
You don't need that.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide, just waiting for jobless claims in America. Alongside Tom Keene and Lisa Bravis, I'm Jonathan Ferro. I'll whip through the price action as we wait for those numbers to drop. Futures down 13, we're down about 1/3 of 1% on the S&P 500. Claims drop, and they drop nicely, 290 against a previous number of 293, the estimate 297. It's just so good to see these numbers south of 300 again. So 290,000 the number, the estimate 297, the previous read 293. If you're interested in the Philly Fed Business Outlook, slight pullback, 23.8, the estimate 25, the previous number 30.7. But Tom, there it is, claims coming in with the right kind of downside surprise. 290 against an estimate of 297, 293 was the previous number. That slow grind, Tom, you've talked about that slow, persistent grind lower in that particular data point.
Technically, the persistence here was back to February of this year, John. That was an elegant point of tension, and then down we go. And what's important here in this high-frequency data, John, we've had 3 very constructive weeks trending down, trying to get down. I'm going to say normal, John, long ago and far away, was something under 220, maybe 210. With a shock of under 200, but you know, 290 is not that far away from the nirvana of previous natural disaster.
I'm with you, Tom, when we were talking about the low twos. So your equity market looks like this morning, down 10 on the S&P, negative 0.2%. The Dow Jones is up there for Tom, that's softer too. Yields are higher by a basis point on 10s to 166, let's call it 167. And outside of that, in the FX market, euro just a touch weaker, no drama here. Euro dollar 116.40. It's onwards to the Fed speak, and it's onwards to November 3rd for that next Fed meeting.
And November 3rd, actually, they're very large, and November 5, I believe, is Jobs Day as well. We need to frame up and see what has changed. We do that with the chief U.S. economist at PIMCO. Tiffany Wilding joins us this morning. Tiffany, in your orbit, in your Excel spreadsheet, what have you changed in the last week, or what are you really focusing on that's subject to change?
Well, I think, and first of all, thanks for having me. But I think what we're seeing is that the economy actually is reaccelerating after this summer period, summer soft patch, as a result of rising cases associated with this new Delta variant, rising cases of COVID-19. We are starting to see, as those case counts are going down, a pickup in spending across leisure and travel services industries. And we're talking about the labor market this morning because the claims data just came out. It does suggest to us that you are going to see a reacceleration in the labor market as well. And we expect jobs in October, net job gains to start to pick up when we finally get that report in a couple of weeks. So we do see some really encouraging signs that the economy is reaccelerating. And again, this makes us more confident that monetary policy can kind of get on with this tapering business that we expect in November, and we can continue to recover from this pandemic.
Will the Fed be surprised by nominal and inflation-adjusted wage growth?
Well, so, I think that we've had a couple of, just in terms of high frequency data over the last couple of months, we've had a couple of very strong wage gains that have been reported in the official statistics. We think that maybe there's a little bit of noise in that, and that you actually could see the wage data moderate a little bit. And that's as you get this pickup in leisure services, which tend to just have lower wage jobs. But I think if you think more broadly here, going out to the next year, we should see wages accelerate. And that's because we've seen a broad pickup in productivity in the economy. I should get paid for how productive I am and how much prices are rising. So we should see wages accelerate. And ultimately, the fact that the labor market is getting tighter, which it is, that should also put upward pressure on wages across a wider range of sectors than just kind of the low income and lower skilled jobs that we're seeing the biggest wage gains right now.
Did you hear that, Tom? If you're more productive, you need to get paid more. That was from Tiffany. Manny better be listening. this morning as Tiffany Wilding delivers that sermon on what should happen in the labour market. Tiffany, talk to me about what should happen November 3rd. Matt Lazzetti was in your seat 24 hours ago talking up a rate hike at the Fed year-end next year. Where are you and the team at the moment?
Yeah, I mean, so ultimately, we think that you probably get a rate hike in the beginning of 2023, and the reason for that is that we still believe that inflation is likely to moderate by the end of next year. Now, there have been some a series of shocks, if you will, that have kept inflation more higher for a little bit longer than I think people were expecting. But we do ultimately think that still comes down. That should give the Fed a little bit of breathing room in the latter half of next year. And as a result, we think that they will ultimately, it'll be 2023 before they hike.
Tiffany, do you think that Fed officials appreciate the tightening of the labor market to its full?
Yeah, so I think that there are, they've certainly highlighted what we would agree are sort of, quote, temporary trends that are probably resulting in the labor market being tighter than it otherwise would be. And, that's health, just general anxiety around health. As a result of this pandemic, a lot of these service jobs, of course, are very public facing. And then, of course, there's been child care disruption. But I do think there are some, kind of more medium term factors here that will take a little longer to work themselves out. But ultimately, we do think that they will. And that's related to actually geography, which is kind of weird. But this work from home dynamic has really changed kind of the local market dynamics and where jobs are demanded. So there may be not, you're not demanding as many jobs in some of these urban city centers. You're demanding those jobs out in kind of more the suburban or maybe even the rural areas. And so we're getting that mismatch. So really the question is, how long does it take for that labor to sort of migrate out? We're optimistic. We look at data on migration from the credit reporting agencies, and it does suggest that, some of these lower income zip codes and lower income folks are able to move. We've seen excess moves from those zip codes, so that's good news. But ultimately, these things take a little time to work out. And then also keep in mind that usually a hot labor market does draw people back into the labor market, and we saw that from 2017 to 2019. So I do think labor markets will get tighter. We do think you get some wage inflation. But again, I think all of this will sort of be moderated to some extent by some labor supply gains that we're going to get next year as well.
Tiffany, in the meantime, as we were talking about earlier today, the market expectation for 5-year inflation, if you look at TIPS, is actually climbed to the highest since 2005 at 2.8%, north of that. Do you think that is correct, that is an accurate assessment of the 5-year inflationary outlook?
Well, I think that, obviously there's more going on with the TIPS market than just in expectations around the near-term path of inflation. But what I would say is I think that the path has become more uncertain lately. And we believe that kind of over that 5-year time horizon, it's going to remain uncertain. And that's because we think we're moving into what we're calling this kind of age of transition, where you have these kind of brown to green transitions, some, trends towards deglobalization, and more of a policy focus on inclusivity. And that's both on the fiscal and monetary side. And that it has the potential to produce some upside in inflation. But I would just also keep in mind here, and I think this is much less talked about, is that there are also some downside risks to inflation as well as a result of this pandemic coming into the next 5 years. And that's that we've seen productivity and innovation really get jump-started as a result of this pandemic. You have the work from home, but then you also have trends towards digitization. And I think, the other thing is we've also seen a big buildup in debt and leverage as a result of this pandemic. It's okay now because interest rates are low. But if we have a negative economic shock, it just increases the risk that you get this, sort of debt-fueled deflationary environment. So I think there are risks to the upside and the downside here. Of course, the market's trying to incorporate that. But I think the other thing to keep in mind here is that if you look further out in the TIPS market, kind of at the 5 years forward, not to get too wonky, it is kind of trading right around the Fed's target, maybe touch above. So I think the market's still giving the Fed a lot of credibility around its longer-term inflation goals.
Tiffany, I was reading through the new outlook. Congratulations, by the way, because I know how much work goes into that for you and the team. And within that, it just seemed to me that as a team, you seem to think the Fed could be constrained down here, that it can't lift rates too much. What do you think that means for how long this cycle will be, the shape of this cycle, given how constrained you guys think the Fed is?
Well, Well, ultimately, we think this cycle, likely will be faster than what we saw after the great financial crisis. And part of that is just because of the policy that we've seen, the really extraordinary policies. So instead of, taking years to get back to trend growth after the 2008 recession, we're likely going to do it, within the next several quarters. And that's really a testament to the amazing fiscal policy that we've gotten. So just by that definition, this should be a faster, kind of a faster cycle. But in terms of a Fed policy, here I really think that when you start to raise rates, as the tightening really gets in the cracks, as sort of was famously described, and really the question is, what is, who is the kind of weakest link, and is that weakest link systemically important? And that's really going to determine how much the Fed can tighten. And you've seen a lot of businesses that have had to take on more debt as a result of just the economic disruptions associated with this pandemic. And so when the Fed starts raising rates, we think that it's really going to turn out that the economy is more interest rate sensitive maybe than people thought. The other thing to keep in mind here is that the Fed's balance sheet is much larger than it was pre-pandemic. And if they want to start to normalize their balance sheet, that just means they're going to hike the Fed funds rate a little bit less than they otherwise would have. So all of that suggests to us that, the target rate in this cycle is probably going to be lower even than it was last cycle.
Tiffany, thank you. And congratulations from us and the team for 50 years of PIMCO. A lot of work's gone into that. Thank
She's
you.
Been there for 50 years.
Tiffany Wilding of PIMCO.
No, she has not been there for 50 years.
Bill Gross, 1971, Tom.
Bill Gross,
years.
starting in
What a
the
story.
mailroom, John, starting in the mailroom down in the basement of the Pacific Investment Management Company, literally sorting mail. The gentleman out of Duke was doing it. John, what I noticed there, and PIMCO's been legendary for the phrases of Mohammed and Bill and others following on. But to me, transition is just a struggle to figure out this great mystery of the new technology. Now, in 10 years from now, do we have an understanding in this so-called transition of what technology's doing to us? The haves, the have-nots, everybody.
And not a sufficient understanding, that's for sure, because it's moved so quickly. I'm going to talk about some of this with Kristen Biddley, the capital markets head at Citi Private Bank. We'll do that, Tom, in about 20 minutes' time.
Tom Keenan, Lisa Bramwitz, to get you to the end of the hour. We've got a number of things coming up. We're working on that right now. Lisa, I just want to go back to the auction and the idea of the wall of liquidity that's out there. We haven't talked enough this week about the absolute wall of liquidity that's out there.
And how much has been provided by fiscal and monetary policy until now. I really want to highlight something Tiffany Wilding was saying. Perhaps we don't appreciate the sensitivity to higher interest rates in this economy, that people basically dismiss debt as all but free at the rates that we see now. That really ties the hands of the Federal Reserve in terms of adjusting that regime. I think that's a really important point as a lot of people start to price in more rate hikes.
And within that, folks, is something we've done, and of course John Farrow does in the Real Yield, which is the distortion of our nominal and inflation-adjusted interest rates. And that does fold over to real estate. And our Shonali Bassick knows it has a modicum to do with a company named Blackstone, and she is with Jonathan Gray this morning. Shonali?
Yeah, absolutely. Thank you, Tom. John, thank you for joining us as the president and COO of Blackstone. You are coming off what you're calling your best quarter in your 36-year history. Now, records are very hard to keep beating. What do you tell your investors about where you go from here and how you squeeze out that next leg of growth?
Well, Shonali, it's great to be with you. I'll just stop for a moment and talk about the quarter because it's nice to focus on it. We really delivered for our customers. We had nearly record appreciation in our funds. We had extraordinary fundraising, and for our shareholders, record fee-related and distributable earnings. And what's driving that, I'd say, is a couple things. First off is where we focused in terms of investing really thematically. Some areas like global logistics, software and technology, the travel recovery out of COVID, all of those have done quite well. You saw that in the quarter. And the second thing I'd note is we continue to expand what our business is about, who we invest for, where we invest. We're moving more and more in core plus real estate and infrastructure, direct lending, and we're also serving more clients. We're serving more institutions, retail, insurance, and we've described it as a ship that's been operating in a narrow channel moving to open water. So it was a great quarter for us. and we're excited about what we can do more for our clients.
Now, John, a lot of this has also come from fund realization, or, investment realization. You've said you've been selling assets as well as investing in them. Now, is it getting harder to invest at these valuations and with all of the choppiness we're starting to see in the markets?
Well, it's certainly trickier as values move up to deploy capital. The good news is we have some competitive advantages. One is we operate in almost all our businesses at very large scale. So this year, we've done something like 13 public to privates that we've been invested in. That's a real competitive advantage given size. The breadth of our platform continues to expand, as I noted before. That helps us a lot. So many of our large investments were in our newer areas. And then again, what we're trying to do is find interesting areas in some of these thematic neighborhoods that we love where we can buy in at a more favorable price. So we bought in India an automotive parts company several years ago that had at that time a very small EV business, but we saw huge potential. We invested in that considerably. The company's called Sona Comstar. That company has gone public, hugely successful investment. We made something like 15 times our investors' capital because we found a really great company that people didn't realize was an on-theme investment. And we're doing that this quarter again in the garage door opener business with a company called Chamberlain, which owns the LiftMaster brand. It's a play on the housing recovery that's happening, as well as e-commerce and access to homes, which makes so much sense through the garage. So I would say our response to a high price market is try to buy things we like, but do it in a little bit of one derivative off or where we find value in those areas. And that's the real challenge.
Do you agree with some of the competitors that you have in the banking industry, some of, James Gorman over at Morgan Stanley, John Waldron over at Goldman Sachs? Do you believe that they have it right when it comes to inflation, that perhaps there are many who are undercounting how much of an issue it's becoming?
Yes, I would agree that inflation is definitely becoming more pervasive, more persistent than people had hoped. And I think that's happening for a couple reasons. One is money supply has grown really significantly by more than a third since COVID, which happened monetary fiscal response to the crisis, but it puts more money in the system, building 40% fewer homes than we did in the past. We've been investing a lot less in energy, of course, for that, because we're trying to balance that out in terms of green sustainability and so forth. And we've seen fewer people in the workforce. Right. So go ahead. Sorry,
so,
Tom.
Jonathan, I want to get away from the CEO speak and talk about the structural solution here and weakness. You came out of the University of Pennsylvania the year of Bill Clinton. You're a card-carrying, bona fide Democrat. You've been hugely charitable. You're an icon across the nation for charity. Help the Democratic Party now with some charity. How do you guys put the progressives and the moderates together? What's the great formula?
Wow, that is a big assignment.
Well, we're going to do it in 30 seconds, so go.
Yeah, sorry, go. So I think it's where there are shared objectives. I think there are things where you could say, how can we help people in lower and middle income areas and do things that drive the economy and drive opportunity for them? So immigration would be one where I think we can help the economy. We can help a lot of people. Ideally, we can bring people out of the shadows. Housing would be another area where if we built more housing, that could drive, down the cost of rental housing and buying homes for lots of people. I think in a green energy context, building housing would help a lot. Education, more investment, doing more in vocational schools, community schools, in order to help people. What I want to do is create more opportunity. I think the debate in the Democratic Party is about whether we should fundamentally change the system we have, or should we give more opportunity to people who have less opportunities themselves today? And I vote with that second camp, which is I think we have a powerful system that creates incredible companies, but more people need access to it. My wife and I created a program, New York City Kids Rise, in order to give low-income children in New York City the opportunity to save.
You underplay yourself. You're buying a building in northern Manhattan in hard cash to build the Gray Elementary School, right?
We help support Harlem Village Academies. It's certainly something that's important to us. We named it after my grandfather, Leon Gray, who believed a lot in education, the opportunity it created. And we do want to help as many people as possible. And I think that debate that you touch on, Tom, is so important because there is a solution where we can bring more people into the system, give them more opportunity, and still keep the, the energy and power of our economic system to create lots of jobs and wealth.
John, that's where I wanted to go, this idea of pairing some of the social objectives with the financial objectives of the Democratic Party. We've heard from them this desire to change the composition of the Fed in large part because of the oversight of Wall Street. And I do wonder, from your vantage point of a $731 billion firm that's expanding into an industry that typically has been private and not regulated as tightly, what do you expect and hope to see on that front?
Well, as it relates to our firm, I would say we are regulated, certainly, in lots of different ways. And we take the responsibility, the transparency, how we operate is really, really important. I think the difference between us and large financial firms, banks, is they're highly levered, right? They operate at 10 to 15 times leverage. They also have access to the Fed window, and their depositors are guaranteed. None of that exists in our private, in our business managing capital for third parties. So we are regulated, but it is a different type of regulation. Our activities are different. And I would just say generally today, I think the financial system in the U.S. is as healthy as I've seen. The banks have a lot of capital. There is really good oversight in markets. We're not seeing big excesses out there.
John, real quick here. I know this big year for succession on Wall Street. A lot of your peers have turned over the ranks at the top. Do you have a timeline over at Blackstone for taking the lead?
No. We feel pretty good about what's happening at Blackstone.
That was so rude.
He'll give it to us next time.
No. I would say this. Look, we have a really good setup here. Steve Schwarzman is an amazing leader, visionary business person, and I can tell you, somebody who's worked with him now for 30 years, it's an incredible gift for me and the others. So we're sticking with our approach.
To be a fly on the wall when Gray and Schwarzman go at it on politics. That must be something. Jonathan Gray, thank you so much for joining us with a small real estate startup firm, Blackstone, this morning. And right now we turn to what's important. We can only do this with Sonali Basak. Sonali, I want to get away from the financials right now. You are so wired in to the pulse of Manhattan. The phone, folks, you have to see it. Her phone bill is so high at Bloomberg, they wanted to put a payphone next to her desk. You're wired in. All the money that's being made, are we going to see the acquisition of the Hamptons? I mean, what's the tone into the end of the year? And then into bonus season and into February.
Is this as good as it's going to get, right? I mean, Blackstone just came in with their best quarter in history. We've seen the banks starting to wane in certain areas, but still make a lot of money. We were just there. But, the markets are getting choppier. And you have James Gorman, on the other hand, saying that there should be a Fed hike next year at the first quarter. And so what to make of this? Yes, bonuses are coming in, but should you be asking for more now while you can get it?
What will these industries, what will these private market shops look like in, say, 5 years, when we start looking at Apollo that is targeting more than $1 trillion in line with what Blackstone's looking for?
Incredible. I was listening to the entire Apollo Investor Day, hours this week, Lisa, hours. You see Mark Rowan take the stage, showing you the transfer. Well, it was really interesting to see that this buyout shop and distressed investor go into what's mainly retirement services in a big way. And then you have them competing on another scale. Is retirement services going along the road of Apollo in the future, or continuing on the road of BlackRock in the future? It's an interesting question.
Well, and Sonali, this really goes to the heart of returns as well. I mean, the whole idea was bigger returns, less liquid assets. How much do those bigger returns get to be smaller, bigger returns as everyone piles into the same game?
Smaller, bigger returns, and on top of them, I mean, there's this big pitch. It's fixed income replacement. But at the same time, you have all of these large institutional investors that can only really limit that amount that goes into those higher fee businesses that are largely in fund format. So you're switching away from this fund format and going into things like buying a thing.
That thud you heard the other day wasn't me falling off my walker, Sonali. That was me seeing the announcement that Mr. Ferguson truly one of the great Americans, will join Apollo. This guy is truly our nation's expert on what to do with retirement. You're the inside pro there. What did it signal that Roger Ferguson, the former vice chairman, the guy that got us through the day of 9/11 financially, what's it signal for Apollo?
It says what they said they want to be, a financial juggernaut is the word that they used.
But you mentioned the dreaded R word, retirement. I know that's distant. Well, maybe not so, but
not distant.
What's it signal?
It's here right now. Remember, they own Athene, which is one of the largest annuity providers in the country and growing fast around the world. So then you add, like you said, Roger Ferguson, who added 1 million customers alone when he was at
TI Craft.
Exactly.
Yeah,
so
exactly.
you add somebody like that, and you start to really shape the way a firm looks.
Okay, Shonali Bassick, thank you so much. A conversation with Jonathan Gray, and then the future here that we see of Manhattan. Lisa, this retirement thing, I am guilty that we don't talk enough about this.
Well, this is the heart of the whole 60-40 debate, right? How do you arrange in a world that ultimately looks changed and where people need income? And that's why these firms are getting so much bigger. They're going to them, the private markets.
To me, I've talked to Mr. Ferguson about this. It's a complete failure of the defined contribution system, and we'll see where that goes. Apollo leading by hiring Ferguson. An eventful day. A gentleman who knows all this, the former senator of Connecticut. 12 noon on radio, on television. Stay with us. Futures at -9. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Six-day winning streak into Thursday from New York City for our audience worldwide. Good morning, good morning. Equity futures just a little softer, down 9. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
From New York, we begin with the big issue. Investors focusing on one thing this earnings season.
Inflation, rising inflation. This issue of inflation.
The inflation concerns right now are really from the supply side.
Supply-driven, an increase in inflation.
There are reasonable concerns about margins.
Companies' earning reports are going to be a really important bellwether indication.
How are we going to overcome these inflation challenges?
Certainly inflation is likely to be higher on average.
And how are we going to overcome the supply chain issues?
How companies are navigating this
so that profitability remains intact.
Companies have actually been navigating these challenges surprisingly well.
We've not really seen a huge impact from the supply chain disruptions.
Look at the earnings story for the S&P 500.
Earnings growth has just been off the charts.
That's been powering the market higher.
And the market keeps grinding higher. Joining us now is Citi's Kristen Bidley, Invesco's Rob Waldner, and Greg Staples of DWS. Kristen, let's begin with you. A recap of earnings season so far. Early days, but from your standpoint, so far, so good?
So far, so good. We're actually seeing very strong earnings. A lot of the concerns that were just mentioned in terms of the wall of worry about inflation and supply side disruptions absolutely are coming through, and companies are coming through pretty strong. There are some disparities, though. So there are companies who are expressing some concerns. You're seeing that in consumer products. But for the most part, I think what we're hearing is a very strong earnings story. Companies continue to deliver, and that a lot of those concerns about how inflation is going to impact these companies, or actually the supply side dynamics, is not really coming through, both in terms of current earnings as well as looking forward.
One of those companies is Unilever, coming out and raising prices in the third quarter by 4.1%, the most since 2012. Clearly, some companies can pass this on. Take a listen to what the CEO had to say.
Peak inflation will be in the first half of 2022, and then it will moderate as we move towards the second half of 2022. So I think we're in for at least another 12 months of inflationary pressures. We are in a once in 2 decades inflationary environment, and therefore we have stepped up the level of pricing.
Rob Waldner, some early thoughts from you, please, sir, that we could have maybe 6 to 12 months more of this.
Yeah, I think, Jonathan, that we really are in a period where inflation is continuing to ratchet up. I mean, today break-evens are pushing up in the bond market. And, yesterday, Fed Quarles said that, they've made substantial progress towards their goals. I think they're very soon going to have to say they've kind of met their goals, because whether you look in the details of inflation reports, or you look at expectations, or you look at break-evens, inflation is going to be well above 2% for a period of time here.
Mr. Staples, you have called this a watershed moment for U.S. policy. How so?
I do. It's a very interesting moment because tapering is not yet even formally announced yet. We expect that to happen in the first week in November at the Fed meeting. And despite every attempt to decouple the tapering from the ensuing liftoff in rates, the market's really engaged and pulled the two together. I mean, what we've seen happen in the last week or so is the market's pulled forward their first expectation of tightening into the early third quarter of 2022, with a second one at the end of the year. And I think that's given a lot of volatility to the marketplace. And it's really a question of whether the Fed is going to respond to the inflation pressures that they're seeing, or per their forward guidance that they've talked about for so long, not let the market force them into what they consider to be a premature tightening.
November 3rd, the next meeting for them. Before we get to November 3rd and even begin to think about the holiday season, here's the message that comes from the likes of Best Buy. They say the following: hint, start your shopping now. Katie Lyons, it's a simple one, but I think we've all heard it before already, haven't we?
Yeah, absolutely. The message that your Christmas presents might be stuck on a ship is definitely ringing in the ears of a lot of consumers out there because, of course, you have the incredible backlogs at ports, a lot of congestion, plus you've had factory shutdowns. All of that makes it harder for companies to actually get products in hand to then deliver to consumers and meet demand, let alone the fact that those shipping bottlenecks have raised prices for freight. They've also raised prices for commodities due to the surplus in demand we have seen and not enough supply. And that all has hit Procter & Gamble, which we heard from earlier this week. Margins contracting by nearly 4 full percentage points. And the fact that higher prices contributed about 50 basis points to the margin, not enough to offset some of those squeezing forces. It goes to show you, as you just said, John, it really is going to come down to the companies that have greater ability to pass on higher input costs to their customers. Unilever, which we just heard from the CEO, raising prices by more than 4%. And the company says that hasn't even peaked yet, warning about another 12 months at least of inflationary pressure. Finally, just a warning on earnings season more broadly. One big takeaway is when you swing, you best not miss, because misses are getting punished in a way we haven't seen in years. In fact, so far this quarter, the stocks of firms that missed estimates have underperformed the S&P 500 by more than 4 percentage points the day after report. That is the widest margin going all the way back to 2017, John.
Kelly Lyons, thank you very much. Look at this headline here from American Airlines. If fuel stays high, industry capacity will decline. What do you think happens to prices off the back of that? That's the problem. This continues. Kristen Biddley, that stat that just came from Kaylee, on the beat down that some of these companies get if they miss, what's the price action telling you? Not the earnings, but the way the market responds to them.
It's interesting because the price action, yes, the companies that are missing are getting punished. The companies, though, that are beating, the price action is relatively muted. So when you look at volumes over the past couple of days, they have also been muted. And I think a lot of that has to do with positioning coming into this earnings season. One of the fascinating things is both on the institutional side as well as the individual investor side, we saw people buying a lot of protection over the past couple of weeks. We also saw people raising cash. So I think positioning is actually quite light. So if there's any signal in terms of that, yes, inflation is going to impact a particular company or the supply chain is going to affect a particular company, they're going to get punished, but we're not seeing too much in terms of upside surprises.
The broader story, the broader macro story, will higher prices hurt growth? That's a big conversation at the moment. And going into next year, to build on what Greg Staples said, 2-year yields are building up. We're starting to talk about rate hikes at the Federal Reserve. Do they have to hike into weakness? That would be the bearish scenario for this market. This came from the Fed's Randy Quarles. He had to say the following: if we're still seeing 4% inflation or around that area next spring, then I think we might have to reassess the speed with which we would be thinking about raising interest rates. Rob Walter, your thoughts on this springtime? Is that a landing zone for you to start thinking about maybe a change in policy?
Well, I think that the Fed is going to be a very uncomfortable spot at the beginning of next year. If you just look at the details of their core PCE calculation, the month-on-month numbers for the rest of this year, the comps are very, very low. So PCE is going to, core PCE will continue to rise. All the other inflation numbers, whether it's wages or wherever you look, I think is indicating upward pressure. And I think if you look at the labor market, we have 2.7 million more job openings than we have unemployed people. This is not a job market with a lot of slack. I think we might get to the beginning of next year, and they will be in the uncomfortable situation of having to say, hey, we've met our FAIT targets. How do we message this to the market without raising rates in the face of what may be slowing growth at that time? So, this could be a very, very tricky time for them beginning of next year.
What do you think they will say? How do you think they navigate that?
Well, I think that they're going to have to raise rates. I think that the market will kind of demand that they do raise some rates, raise rates somewhat, and probably falling immediately on the end of the taper. But we will see. But depending on how that inflation path flows through, that may end up being hiking into at that point maybe. We'll see, but it could end up being a policy mistake.
There's a real risk here that we do get a policy mistake. There's a real feeling that this cycle's going to be different somehow. We caught up with Joachim Fowles of PIMCO about that in the past 24 hours. This is what he had to say.
Both growth and inflation, I think, will be more uncertain, more volatile, and I think we're looking at fatter tails for inflation. So both the risk of higher inflation has risen, but also the risk of much lower inflation. We should not assume that the Fed steps in when there are wobbles in markets.
Greg, it sounds like a typical economist's answer. On the one hand this, on the other hand that. The fact of the matter is, though, the real takeaway from that is the range of outcomes is very, very wide still going into next year. And there's a huge amount of uncertainty still about what this cycle looks like, the characteristics of it, and the duration of it as well. Greg, are you spending much time thinking about that at the moment?
Oh, absolutely. I don't think you can look through what's going on right now with sort of your lens of pre-COVID, interpreting data, et cetera. And when you look at inflation, that's clearly scaring the market right now. The prints are very Halloween scary. But you have to disentangle it. It's coming from, we think, three different sources. One is clearly the supply chain, but that's probably going to disentangle itself over time, and some of those pressures are going to ease. Second is commodities. There are some both supply and demand driven there. Demand could fall off if what we think happens, the China economy cools down a little bit, but there is some supply issues there on energy, as we're not seeing the kind of response that we'd expect to see from U.S. manufacturers responding to $80 a barrel oil. We think it's going to take more like $100 a barrel before they start putting those fracking rigs back into place. And the third is labor. That's the real unknown. How do we persuade reluctant returners to come back into the workforce? How do we get labor force participation back to pre-COVID levels?
Yep.
And we think it's going to happen at a new pre-COVID, post-COVID supply-demand equilibrium at higher wages, and where that equilibrium settles in is going to be the real question for inflation.
How do you assess how tight this labor market is if you don't know where the participation rate is going for the next several years? That's a big question. Governor Waller of the Federal Reserve right now is responding to some of the elements of this conversation, saying the following. He sees inflation abating in 22 towards the 2% Fed goal. Speaking at a virtual event, that's the base case. Here's the balance of risk, though, for him. Inflation risk to the upside. You hear a lot of that from Fed officials now. That's been the change over the last several months. Do we get a bigger change than that? Governor Waller saying the following. Next few months critical for me on the inflation outlook. The Fed may have to act faster if inflation stays too high. Just a final word, Kristen, on the Fed, off the back of that comment, that the next few months are critical. Are they critical for you?
The next few months are absolutely critical. I think the comments around, I think we have to change the way that we're talking about inflation, right? I think this whole concept of talking about it as transitory, what does that really mean? You've heard all three of us actually make comments on the fact that inflation, really what we're going to see next year is it's going to moderate, but we're still going to have elevated inflation compared to what we've seen previously. And then the question is whether the U.S. consumer can handle that and whether certain companies can handle that. I think one positive element to this is remember that the U.S. consumer is actually quite strong. That excess savings of about $2 trillion that has been created since the beginning of the pandemic, and corporate America is actually pretty strong in terms of looking at where their balance sheets are. So I think you do have a counterbalance, but it does put the Fed in a position where they have to act.
For all these worries, we've come within 5 points of an all-time high in the last 24 hours. It's worth considering that through the rest of this program. The guys are going to stick with me alongside Kristen Biddley, Rob Waldner, Greg Staples. Coming up, mounting concerns about slowing growth in China.
We really need to monitor the weakness in the Chinese economy. We have issues both on the domestic side and also on the external side. It's quite concerning because it has been the cornerstone of the economic recovery.
More on the slowdown in the world's second largest economy. Up next from New York, this is Bloomberg.
Is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating. I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at you'd have to look at what was you're defining as strategic or critical.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
China has a policy tool if the slowdown is accelerating further. But the slowdown of China's growth, you have to think this is inevitable consequences. You cannot grow close to 8 to 10% forever. We are expecting that their growth rate will be around 6% in the next 5-10 years.
The IMF saying China has the necessary tools to cushion an economic slowdown. This as new infections rise, with Beijing reporting its second case, and that's all it takes to ask residents to leave the city. That's the level of tolerance in China still around COVID-19. Damien Sassower of Bloomberg Intelligence joining us now. Damien, it's so important, isn't it? When we talk about cases in America, it's very different to talking about cases in Beijing.
That's exactly right. I mean, the COVID zero policy pursued by Beijing, I mean, the recent outbreak is tied to an elderly couple who broke the rules with visiting tourist sites throughout northern China. And so, yeah, the COVID zero policy means they're going to go into shutdown, and that's going to lead to supply bottlenecks, more disruptions, and that's going to affect the real economy. But really, the focus still has to be on the property sector. We saw that Evergrande had agreed to a 3-month extension on its $240 or $260 billion jumbo fortune loan, but they have the $83 million coupon coming through this weekend, and we're going to see if they actually default on that. Casa also has a coupon payment of $36 million due tomorrow. So a lot of clarity over the next 48 hours on the property sector, Jonathan. But what's really catching the attention of most this morning, Enes Kanter, an outspoken NBA player from the Boston Celtics, who has in the past spoken out against Erdogan and others, is basically speaking out against President Xi on Tibet. And, as we are well aware, in 2019, 2020, the NBA was banned by CCTV and by Tencent in China due to comments by the then general manager of the Houston Rockets. And so it cost the NBA $500 million. $500 million, Jonathan. So something similar might be in the brewing here.
This is the challenge right now for corporations, institutions like the NBA. Damien, once you allow staff, players to start flirting with social issues, and often very, very justified, important social issues, where's the line? Where is the line for them? And on China specifically, and I think this is a corporate question as well, how do you appease an increasingly progressive consumer base at home, America, and appease a dictator, in the words of some of these basketball players, and in the words of many too, over in China, and maintain access to that market? And I think increasingly, Damien, that's going to get harder and harder and harder.
Yeah, no, exactly. And what do you do, Jonathan? You shut it down, right? They shut down Weibo. Any reference to Enes Kanter is coming up blank. Any reference to the Boston Celtics is just basically giving you last night's score, the loss to the Knicks, obviously in double overtime. So look, the reality, Jonathan, is that, the government's got its finger firmly on the pulse of, social media in China, and they're going to try and suppress this.
I sense that reference to the Knicks was filled with pain.
No, it was
is that right?
It's a good feeling this morning. I am a Knicks fan, Jonathan.
Oh, you are? Okay. All right. You're feeling good? You were up late?
I was up late, yeah, for sure.
Well, I'm pleased that this
watching Turkey, though. Not watching the game, watching Turkey.
Do you want to talk about Turkey briefly? 200 basis point cut, Damien. Can we just sit on that? A 200 basis point cut when the rest of EM is hiking. What are they doing?
Yeah, no, I mean, real yields are firmly in the negative there, and they're going to get worse. Look, I mean, I think the central bank governor did say that this was the last cut of the year. We'll believe it when we see it. He's not the central bank governor. President Erdogan is the central bank governor of Turkey. But you're absolutely right. Look, I mean, it's very difficult to short the Turkish lira because yields are so high. I mean, it costs a lot of money to hold that short. The way to do it is to use 2-year, 5-year CDS spread curve flatteners, but we'll talk about that another
We can do that another time. I understood all that. Thank you, Damien, as always. Inflation near 20%. In Turkey right now. It's unreal what's going on. Damien Sassower there of Bloomberg Intelligence. Still with us, Kristen Bidley, Rob Waldner, Greg Staples. Kristen, I want to talk to you about EM right now, just briefly. The bulk of EM is hiking. They're not cutting like Turkey. China's slowing down. What does it mean for how much global exposure you want to take right now?
You know what's interesting is, so on the EM side, we were positioned, we had positions in EM about 12 months ago and into the beginning of this year. We were invested in Chinese equities. We were invested in Latin America. I think the challenge, so just starting with China, for example, is you can have a long-term outlook on China, but the short-term outlook is very volatile and very choppy. Effectively, what they're doing from a government policy standpoint has a J-curve impact to it. And while we've seen some pretty sharp corrections in a lot of areas of the market, obviously property is one of them, but that extends to tech, education, and healthcare. This is something that makes it really just uncomfortable to invest, even if you can say, look at the growing middle class, look at the fact that China wants to be part of innovation when it comes to healthcare. There's some long-term positive trends, but the short-term is messy.
Sometimes the biggest opportunities are where you feel most uncomfortable. Here's BlackRock's Ben Powell talking about that.
We're dipping our toes back in, and we do think there is room for more tactical upside, but the market has got a better understanding of that now. And the market has continued to be resilient through that.
Rob Waldner, it is a trade for the brave. How brave are you?
Yeah, well, Jonathan, we think that EM local does have some value. I mean, if you look at the spreads between local yield curves and the U.S. or developed market curves, where we have negative real yields, they're very attractive. So the question is how, over the medium term, you realize that, but over the short term, the factors that we talked about just a moment ago, which is the Fed being in a pickle shortly and, growth kind of slowing, we kind of missed this ideal window that we thought we'd have where we'd have strong growth, easy policy in the U.S. and EM growth picking up. We kind of missed that window. That would have been very, very strong, very, very good. So medium term, we still like it. Short term, there's some headwinds.
I just want to sit on these headwinds right now and go through them. Slowing consumer spending, there's an energy crunch, supply chain slowdown, regulatory crackdown, and credit market risk all on top of that. Greg Staples, it's hardly the profile of a market you want to enter right now. I'm trying to understand where peak pain is. What does it look like? What are the things you look for to understand? I think we've seen the worst of this.
Well, first of all, turning over to EM, it's not a market, one single unified market. It's a market of many different countries. And China, they were actually very successful with the sovereign bond issuance this past week. We'd be more cautious, I think, in some of the Chinese credit markets, particularly obviously those that are related to property. But there are opportunities, we think, for example, down in Latin America or perhaps in certain parts of Central Europe, where EM is actually an attractive one. In terms of the pain trade, it's sort of interesting. We think we've seen a bit of an unwinding of some of the bets on credit over the past 2 to 3 months. Excess returns on credit markets have really been neutral. They haven't seen much outstanding performance there, seeing a little bit more flow coming in, but we don't think that there's a lot of leverage in the credit markets that needs to be unwound if we do get a slowdown. And from our perspective, we do see portfolio managers a little bit short in terms of duration, which makes us a little concerned. That's what I think sparked the strong rally that we saw in rates in the second quarter. But for the moment, at least, we don't think that there's a lot of pain trade in seeing rates go much higher from here.
What are you expecting from the US dollar with all that in mind, Greg?
Very trendless. We've been thinking that the dollar could be weakening, but it's shown a little bit of strength more recently. And quite frankly, it's been a sideways trade for, almost 2 or 3 years now with not a lot of great trend, and we don't see anything breaking that.
DXY right now just short of a 94 handle, 93.63. The guys are going to stick with me. Kristen Bidley, Rob Waldner, Greg Staples. Coming up, the morning calls, and later, Tesla reporting record margins, overcoming chip shortages that have been hindering other automakers. We need to talk about this name and why seemingly one big issue doesn't affect everyone in the same way. 856.61 on Tesla, down a little more than 1%. That's that stock in the pre-market. Let's talk about the broader market. Your equity market, 6-day winner streak into Thursday. Equity futures this morning down about 8. We're negative 0.2% on the S&P 500. From New York, this is Bloomberg.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Your all-time intraday record high is 45.45 on the S&P. Yesterday, 5 points short of that at 45.40 on a 6-day winning streak into Thursday. We're a little bit softer, but bear in mind we're just off all-time highs. We're down 6 on the S&P, negative a little more than 1/10%. On the Russell, down 0.04%. No drama here. On the Nasdaq, down 0.2%. Switch up the board and get to the market. I want to talk about 2s, 5s, and 10s in the bond market, and 5 specifically. We're just off the highs for the year on the belly of the curve. We're pricing in more hikes here, and that rate hike dance is getting pulled in to 2s again, up 2 basis points, back through 40 basis points, let's call it 41. That's the price section. Here are your morning calls. First up, Cowen, raising its Macy's price target to 32, an outperform rating, saying that a spin-off of its e-commerce business could be worth up to $12 billion. Citigroup raising its price target on Goldman to 480, seeing further market share gains with management delivering on its strategy. And finally, Baird raising its Tesla price target to 888, touting the company's impressive profitability and industry-leading margins. Coming up, much more on Tesla earnings, overcoming the chip shortages that are smacking around other automakers. Your opening bow just around the corner from New York City this morning. Good morning. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. So here's your pullback. It's tiny. After 6 days of gains on the S&P, we pulled back by about 1/10%. On equity futures, we're down 6 on the S&P. On a NASDAQ, down about 30, down 0.2%, just short of all-time highs. The opening bell in New York City, about to ring. Switch up the board and get to the bond market. It's ringing right now. There's your 10-year yield, coming in just a little bit at 165.51. I'm very focused on 2s out to 5s. That's where the rate hike dance debate plays out. And that rate hike dance is getting pulled in. Deutsche Bank's Matt Lazzetti on the program with us 24 hours ago, talking up a rate hike at the back end of 22, maybe December next year. Others pricing in something sooner. In the FX market, euro dollar weaker, 1/10%, 116.43. The fun and games taking place in EM with the Turkish lira. We touched on that a little bit earlier with Damien Sassa. In a crude market, energy softer, lower, negative 82.57 on WTI, down about 1 percentage point. We're negative 0.89%. At the opening bell then, about, what are we, 30 seconds in? We're negative 0.1% on the S&P. Bottom of the pile is energy, down 0.06%. Top of the pile, pretty defensive this morning, as you might expect. Healthcare, utilities, consumer staples, healthcare advancing about 0.25%. If you want to pick out a single name, let's pick out Tesla, reporting third quarter revenue overnight after the close yesterday, falling short of Wall Street estimates despite beating profit projections and pushing through widespread supply chain issues. For more on this, let's bring in Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, Tesla pulled in $1.62 billion in profit in the third quarter. That was a record, and this marked Tesla's 9th consecutive quarter of profitability. But the margin expansion is really the noteworthy story here. Gross automotive margins expanding to 28.8%, which also was a record. And that is despite the challenges like other automakers Tesla is facing in regard to supply chain issues and the global semiconductor shortage. Clearly, they have been able to manage those issues better than some of their peers, and they're proving more resilient on that front. I would point to what one analyst over at Piper Sandler is saying, though. He says the third quarter likely represents the high watermark for margins, at least for the next few quarters, because commodity inflation, the opening of those new factories in Austin and Berlin, is going to take a toll. And speaking of those factories, obviously the goal there, while ramping up production could affect profitability, the end goal is just more capacity. Already, Tesla delivered more than 241,000 cars in the third quarter, also a record for the company, but that still was not enough to meet demand. I would point to what we heard from the CFO on the call. He said, we're trying as far as we can to maximize capacity and to be able to meet the demand that we're receiving, but the net of all of this is we are not able to increase capacity fast enough. So once again, it comes to that robust demand story and not having enough supply to meet it, which is a story that we know is not just true to Tesla. Companies across the board grappling with that this earnings season.
Kelly, thank you for the summary around Tesla and others as well. We're down about 0.5–0.6% on Tesla this morning. A big question for a lot of people. Tech analysts are starting to cover Tesla as a tech stock. That's not a new story. We've seen that over the last several years. What interests me is how they start to cover the others, GM, Ford, as also maybe a tech stock. The likes of Dan Ives of Wedbush, I caught up with him yesterday and went through his coverage list, just company to company, the likes of DocuSign, the likes of Tesla, and all of a sudden in the last 6 months, popping up in there is GM. This is what Dan had to say about what constitutes a tech stock.
My view on GM is that this is going to be an EV transformation story, you know, as it gets re-rated. And I think what you're seeing at GM and Ford, Renaissance and Detroit, you start to get more of a re-rating. A year from now, GM's a double. GM and Ford, those start to get re-rated on disruptive technology as they convert that base. You start to do some math, you convert about 10% of GM's base by 2025. I think there's a 3-digit stock.
A triple-digit stock. Now, the team in the control room can bring up GM, Ford year to date. Those two names have had massive years. I want to bring back in Kristen Bidley, Rob Waldner, and Greg Staples. Kristen, The coverage of the automakers right now, more tech analysts are having a look, seeing the EV game take place in a bigger way. What's your take on some of these names right now? Not individually, but just as a sector at the moment.
I mean, I think it is interesting just in terms of looking at automotive in tech. I think the bigger story, though, is in terms of some of the things that have actually put pressure. If we look at tech more broadly and kind of some of the subsectors that are contained within, this idea of rising rates and the impact that this could potentially have, the way you combat that is with record profits. So that's exactly what we saw with Tesla in terms of being able to defeat some of these supply chain dynamics. And I think the other thing to keep in mind is it's much easier to fix medium to longer term the supply side of the equation versus the demand side. So I think as long as we continue to see that strong consumer demand, and as long as they're able to navigate some of these supply side issues, I think you'll actually see continued strong earnings going forward.
And Kristen, these are big names, and for some people looking back on where we've been over the last year, they might be worried that they've missed this. They've missed the change. They look at the performance and think, really, that's happened already? What do you say back to them, the people that are worried about missing this market?
Well, I think about missing the market, what's really interesting is everyone's looking at, yes, you can look at individual names and how much they've appreciated, and there's some really stellar outperformers. But oftentimes when people are looking at that, they're looking at the overall index level and saying that the S&P 500 is about to reach all-time highs. When you look under the surface, over the past 12 months, we have 54% of the companies in the S&P 500 have experienced a peak-to-trough drawdown of 10% or more, and we have close to 20% that have actually experienced a peak to trough of 20%. So this under the surface kind of anticipating some of these challenges, delineating between winners and losers, there are absolutely opportunities to get invested and take advantage of that underlying volatility that's happening at the single stock level.
Let's talk about a single name just a little bit longer. Tesla, it's up 0.4% now in the market, early days, but look at the market cap, $872 billion. Now, Rob Waldner, I'd love for you to work through this with me. Do you remember back in the day on Real Yield when we used to bring up the Tesla debt issue from several summers ago, and it had a 5.3% coupon and people used to laugh about it? That credit is still a double B credit. It's high yield, and yet the market cap is $872 billion. Rob, have you ever seen anything like this before? To say that the equity has a market cap of $872 billion and the credit of the same company is a junk-rated credit. Rob Waldner, what do you make of that?
It's all about growth prospects, Jonathan. I mean, you're right. It's quite extraordinary to have that level of market cap, but I think it tells you what's the underlying volatility of the growth prospects for the company. And that's what we as debt holders really care about, right? The market cap is our cushion, but the volatility of that market cap is what really matters. So I think that's kind of how you square that circle.
Greg Staples, can I get your view on the same subject, please?
Well, it's just that I think a lot of the assets that you were traditionally looking for as a fixed income investor to cushion you on the downside are not necessarily there for tech companies such as Tesla. You, again, believe in the model itself, but if you're looking at bricks and mortar to give you protection in a liquidation type scenario, that's not what you're looking for. You're looking for the growth prospect. So I don't see any problem with the valuation there.
Greg, give me that cushion for the downside right now. For a cross-asset portfolio manager at the moment, where do they find it?
Oh, I'm sorry, I thought I was asking somebody else. I think that within the fixed income market, you're going to have to do a little bit of shorter duration. You're going to have to stick with higher quality credit. And when you're in the equity market, I think you're from somebody who's looking for income again, look for higher dividending stocks that are going to provide income cushion in a lower interest rate environment.
Rob Waldner, same question to you.
Yeah, I think, we talked about EM a moment ago. We talked about the differentiation of China versus EM broadly. There's a lot of negative headlines out of China right now. But bottom line, growth will be around potential in China. They have a very strong external account. They are likely to be easing policy going forward. So all that says to me that, you can get real yields that are positive in Chinese government bonds in renminbi. So that's a place to go where if you have problems develop here that we've talked, like the headwinds we talked about in the U.S. or in Europe, you'll be isolated in Chinese government bonds.
And Kristen Bidley, the final question to you. Last time we caught up, everyone was concerned about the month of September. You weren't as concerned. You talked about not going to cash. What is it that still gives you confidence in this equity market? Just a final question on where that confidence comes from and how much therapy you have to provide clients right now with seemingly so many things to worry about.
I think ultimately what gives us a lot of confidence is remember that these record high levels in the stock market are actually driven by record high earnings. So this is a market where we're getting back to fundamentals, and that's what's going to be critical going forward. And so ultimately, from a portfolio positioning standpoint, let's just review some of the things that investors are worried about. They're worried about inflation. They're worried about rising rates. So what does that mean? It means cash is punitive as an investment vehicle, and that duration is punitive. So what you have to do is create a diversified portfolio where you're taking advantage of some of the valuation differentials, particularly in markets like the UK, the Eurozone, and then also leaning into some of the opportunities in terms of the long-term secular trends that we do find in growth, that we find in areas like cybersecurity. So I think this balanced approach, finding yield outside of traditional sources of yield, and really just kind of honing in on what you're worried about. And if you're worried about inflation and rising rates, there's a way to combat that with portfolio allocation.
Kristen, thank you. You were confident, constructive, and so far so good. You've been right. Kristen Bitterly, Rob Waldner, and Greg Staples. Thank you, guys. Bit of an update on a breaking news story. Let's pull back and get you up to speed with Abigail Doolittle.
Well, John, we have a 2-year saga essentially coming to an end. WeWork has now gone public via a SPAC, opening on the NYSE at $11.28, essentially up 8% under the ticker WE. And of course, so much has changed since the debacle back in 2019 when they tried to go public and then did not go public, to some degree linked to then CEO Adam Neumann. We now have a new leader. We also have fewer employees, a global pandemic, and of course, the effect of workers working from home to some extent. But one thing remains the same for this company, John. It loses money, more money, in fact, than it did in 2019. Nonetheless, right now, investors seem to be embracing the shares of WeWork, up 4.4%.
After all that drama, there it is at 1086. Coming up on this program, President Biden continuing the push for his Build Back Better plan.
This has been declared dead on arrival from the moment I introduced it. But I think we're going to surprise them, because I think people are beginning to figure out what's at stake.
We head to D.C. next. From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
My Build Back Better plan is designed to get us moving again. These bills are not about left versus right, or about moderate versus progressive, or anything that pits one American against another. These bills are about competitiveness versus complacency. They're about expanding opportunity, not having opportunity denied.
The President of the United States pitching his spending plan as Democrats continue ironing out their differences. The White House spokesman, Andrew Bates, saying the following: there is an expansive menu of options for how to finance the President's plan to ensure our economy delivers for hard-working families, and none of them are off the table. Let's bring in Anne-Marie Hordern down in D.C. Morning, Anne-Marie.
Good morning, John. Yesterday, we heard the president in his hometown in Scranton pitching his bill. He's going to do the same this evening at a town hall setting, but he does seem to need to do a little bit more work when it comes to pitching it to his own party. Yesterday, it felt like a bit of progress, but today, it almost feels like square one. And really, this has to do with the revenue. How are they going to pay for this to make sure they're not increasing on the deficit? Senator Kyrsten Sinema really not on board with the current proposals on corporate and income taxes. So now they're opening up the books, potentially a billionaire's tax, potentially tax on buybacks. These are things that they are now going back to square one to discuss. And second, I would like to say that the White House had these meetings on Tuesday, and coming out of those meetings, we heard things like community college. That was likely going to fall by the wayside. Also, the child tax credit, that would only be extended a year, not through the 2025. But Speaker Pelosi said what was discussed with rank and file Democrats in those White House meetings doesn't mean a final decision. So then you start to think, well, then what progress was really made in trying to get to a middle ground between these two wings of the president's party?
We called it a baby step, Anne-Marie. Maybe it wasn't even that, a baby step backwards now as well. Can you help me out with this one? There was a report yesterday from a publication here in America called Mother Jones. This was the quote: Senator Joe Manchin has told associates that he's considering leaving the Democratic Party if President Biden does not agree to his demand to cut the size of the social infrastructure bill. Senator Manchin, Anne-Marie, as you know, pushed back against those reports using some, let's say, choice letters, the first one B and the second one S. Can you help me understand what's going on here?
Yeah, provocative language immediately, and a little bit angry from Senator Manchin when he was approached by reporters about this, really calling it nonsense. But Jonathan, this is not the first time. When he was a senator-elect from West Virginia, there was reports like this, potentially towing that line. He comes from a very conservative state. He is the only Democratic senator from that state. So that's the first thing we should, in terms of framing what this really means. Second, potentially this report is being out there as leverage. This is some serious leverage to use. If you do not meet me to where I have outlined where I can come on board, a package that I deem tolerable and sufficient for the country right now, then you know what? I might jump ship. And that's very nerve-wracking for the Democrats, given the fact that the midterms are next year. And then just one thing finally, though. Senator Manchin, if he was to go to the Republican side, Jonathan, I don't think he'd have as much power. The way he holds court in Congress today likely would look different if he was part of the GOP.
He uses my kind of language, as you know, privately, Anne-Marie. You know, that's the way we like to talk. Anne-Marie.
Mine too, maybe.
AMH, yes. Yours too. That's for sure as well. Anne-Marie, thank you, our Washington correspondent. Your equity market down about a tenth. Your sector price action. Here's Dave Wilson.
Thanks, John. You've got 8 out of the 11 main industry groups in the S&P 500 lower in early trading. Commodity producers leading the way down. Energy, materials. You're seeing industrial stocks tail off a bit. Consumer discretionary, though, which you would tend to fit with those other groups, I mean, it's moving higher, and a lot of that's tied to Tesla. because the electric car maker had numbers out late yesterday. The shares fell overnight, and all of a sudden they're moving higher. I guess people getting excited about Tesla getting close to its record from earlier this year. And I want to focus in on an area within the industrial group that's doing particularly well, transportation. Dow Jones Transportation Average has 20 stocks. We've heard 5 of the companies report earnings since late yesterday, and it's been 4 out of 5 in terms of the reaction. You look at the airlines. You've got Southwest down. That's the one exception. But American and Alaska Air are up. And similar story in railroads with CSX and also with Union Pacific. So, this is a group that set a record just back in May. We'll see if a day like today helps the group reach another high.
Hey, Dave, thank you, sir. Great work, as always. Our stocks editor there, Dave Wilson. Your equity market just a little bit softer after 6 days of gains. A bit of an early finish for us this morning. From New York City, good morning. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
Surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
I'm Eric Schatzker. Welcome back, everybody, live in Toronto at the Capitalize for Kids Investors Conference. It's all about best ideas, and you're about to hear some from David Fizel. He's the CEO of Honeycomb Asset Management. It's a $1.5 billion equity long-short hedge fund with an extraordinary track record, 58% in 2020, an average of 19% return over its 5 years. David, it's great to see you.
Great to be here.
David, you built Honeycomb around a motto. I might describe it as a mission: invest in the future, short the past. Explain.
Sure. Well, first, thank you so much for having me, and it's so great to be here. Today, Capitalize for Kids is something that's very important to Honeycomb. We believe in natural, organic, scalable growth, and being here today really is on mission for us. In terms of our investment strategy, investing in the future and shorting the past gives us a very wide lens. So while our portfolio happens to have a lot of software companies which are changing the world, including the digital disruption that we see going on across many, many industries, it allows us to also see who's not keeping up. And that is something that I think during the pandemic, we really learned. If you're not keeping up, you're falling very, very far behind. So there's a tremendous amount of dispersion in the companies out there. And so
maybe not just falling behind, but DOA.
Yeah, for sure.
David, what are some of your highest conviction bets?
Yeah, well, for us, the creator economy is something that we're really focused on.
Creator economy.
Yes. You know, in today's world, the idea of graduating from school and working for a 9-to-5 job in a big company, that's not as appealing to young people. And there's an entire business that's becoming quite common, which is freelance. And so the freelancers, they use companies like Fiverr. That's a portfolio company of ours. And
F-I-V-E-R-R, right?
Yeah, that's correct. What this company does is it's a marketplace. So if you are a person that does web design, if you're a person that builds logos for websites, you know, you might have worked for a company or you might have had a headhunter try to find you a job, but now with Fiverr, you can find a marketplace where someone's looking for that service and you can price your service. And having that matching buying and selling of your services allows you to choose to work on your terms in a way that hasn't been done before. And so this company takes a take rate. So if the job is worth $100, they get a certain percentage of that for every job that they fill. And that is something that is powering the economy. So then we think about that in the value chain. And, well, what do those creators use? Well, they use companies like Adobe and Photoshop. And Adobe is a business that you look through an economic recession like last year, this is a company that still grew double digits. And so when we find powerful compounders of secular growth, we love to invest behind that. You know, on our math, something like a company like Adobe will earn $25 a share of free cash flow in a few years. That to us looks like a very good investment.
David, I looked at your holdings and I noticed two things were, if you will, well, they were not there. I won't say they were missing, but I didn't see any Tesla and I didn't see any crypto. How come?
You know, for us, we're quite focused on the things that we are quite passionate about, and software tends to be the thing that is what's been most of our focus. I wish I had more bandwidth. I think those are amazing opportunities, but you know, I think there's a lot of different ways to make money, and we're pretty happy with the way we do it. But I have my hats off to those, especially Tesla and what Elon Musk has built there. It's just not something that we spent our time on.
Not just Tesla, but it's SpaceX, which is...
Well, SpaceX is something we have some exposure to, and that's something that I first visited the company in 2013, and that was a very unique experience for me. I thought about that business, and as a mission-based firm, this was before my predecessor firm, I was just so impressed. If they built the reusable rocket, then the cost of flying a rocket would go down by 80% because you no longer blew it up. Like right now, you know, if you take a plane and leave JFK and go to Heathrow, the rocket blows up. But when you reuse it, then it has a lot more use cases.
You've probably heard the name Cathie Wood. She's built a reputation as the stealth-style champion, if you will, of investing in innovation. But I also noticed there's not a lot of overlap between her portfolio and your portfolio. What's unique, what's differentiating about your approach?
Sure. For us, we are very valuation sensitive. So while we may believe that a company has unlimited potential, there's a price at which we don't believe the risk reward is favorable. And so every position in our portfolio has a price target and a risk target. And so we want to put the skew on so that we have more than 2-to-1 upside. And for us, we're kind of second inning the seventh inning players. We're not going to be the first ones there, and we're not going to hang on for the last part. But if we can get the fat part of the bell curve, then on a risk-adjusted basis, our return should be better.
Do you think that sensitivity to valuation is an important discipline in investing that people tend to lose in the midst of a bull market like the one we're in right now?
You know, in the time that I've been doing this, you have to pay attention to valuation. When you are not willing to sell, that winds up being a very troubling outcome for many different investors. So we have to have a game plan, and you got to stick to the game plan. But there are a lot of different ways to make money, and I respect all of them. It's just what's worked for Honeycomb.
You play in both public and private markets. Is the illiquidity of the private market worth the risk for a hedge fund?
I would look at that question a little bit differently.
Okay.
Okay. I am a financial analyst. I am a player, coach, owner. And what I would tell you is I'm the Uber analyst and then Instacart analyst. So for us and my whole team,
in other words.
you do the work. And these companies are very, very large companies in the private markets. So to not look at them, to have blinders on, well then I don't know if I'm really thinking about Uber's driver supply situation correctly, if I'm not thinking about what is Instacart doing and what's DoorDash doing and all the other companies. Just because they're not public doesn't necessarily mean we shouldn't be tracking them. So in our research process, it's very important for us to understand who are the disruptors and who's being disrupted. And that adds a lot of alpha to the short side too.
Well, Almost everything we have talked about up until now is long. Let's talk about the short book. This market, since the beginning of the pandemic, at least since the early days of the pandemic, has not been too kind to shorts. How do you operate as an investor on the short side?
Well, we certainly construct our portfolio in a way on the short book that might be a little bit different than others. About 80% of our short book is single stock shorts. 20% would be index hedges. And I would tell you that within the short book, we segment it as to 1/3 hedging some of our long books. So let's say we were long an advertising-based company, we might be short an advertising-based company.
Like a pair trade?
A little bit. It might be a valuation pair trade. We just want some protection in the event that things, go wrong. And having that sustainability of returns is really important. Then we have 1/3 that's secular shorts. These are melting ice cubes. I don't know what quarter they're not going to work, but I think they're...
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings there.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks